right, everything looking good. Should be live. Let's go ahead and get this stream started. Welcome back to the channel, Crypto Trend Trader, with our midweek market update. It is 8 p.m. Eastern Standard Time on March 9th, 2022. Before we get started, I'd like to remind you it's not financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research and trade responsibly. So obviously quite a bit of market volatility. We see essentially a short-term, at least reprise or reversal in many of the assets or asset classes. Go ahead and take a look at some of the specifics. As we have seen, obviously, oil, gold, and the dollar on a rip lately. And as of today, last couple of days, I've kind of seen them let up a little bit. We have obviously seen some crazy moves in some of these markets. I don't have to tell you guys that a lot of these moves are unsustainable. There's obviously, I think there's two main drivers in these markets right now: fear and speculation. And those two things have, well, very often will push things extremely high to the upside, extremely low to the downside. So the key is for us to be able to identify when these trends are getting oversold, overbought, overextended, whatever situation, and then, you know, be able to capitalize on that. So let's take a look and have a sort of a deep dive into some of the trends. We have a couple of questions also from the group members, so we'll go through those, look at some various assets, just run down our regular lineup, a couple of different ones as well, take a look at the international markets, and of course our cryptos, the commodities and overall sectors, and then we'll look at tech stocks, and yeah, that ought to pretty much round it out for tonight. If you are interested in the group, again, you can still leave me a message, but as of now, the group is closed until further notice. So let's go ahead and jump on in. We'll take a look at our TNX first. So we have the 10-year Treasury yield. To anybody that has been watching or has put together their own 210 chart, I don't have to tell you that we are now within, you know, basically around 25 basis points of the yield curve inversion. So at this point in time, it looks all but inevitable. We're also very quickly approaching the descending trend line that we have topped out on every single previous cycle, every time resulting in a recession with another lower high. So at this point in time, the recession looks imminent. So let's talk about how we're going to beat these markets and position ourselves for that recession, as well as, you know, make money on the way in, and then how we can identify when we want to be buying these assets that are getting, you know, overly beat down because of fear, capitulation, or whatever the case may be. So here on the TNX, you know, as far as I'm concerned, nothing has changed for me on TNX. You know, we basically have run up from essentially that 0.4 on here. We ran up, put in a high. We had a nice little pullback, and now we've put in another high. As far as I'm concerned, it's just going to continue to the upside. Now, obviously, we're at a key resistance level. We pulled back to it, essentially, came back below it, chopped around a little bit. You know, there's quite a bit of resistance as we scroll back. So anytime we're coming up through a large amount of resistance and volume, and it goes back for a long period of time, we would expect it to take a while to move through that. We don't often expect it to just shoot up through it in like one single big candle or like very quickly. So obviously we have quite a bit of price action going back to 2011. We have a low down here from 2008, and then, you know, a bunch of chop that has taken place in the meantime. So that's what we're paying attention to, is just how we react to these areas. We're obviously seeing a little bit of a pullback on the weekly. This is the one we discussed. We basically talked about this, you know, a couple weeks ago. Once we broke above the 200 simple, we expected to come back down and retest the 200 simple and 200 exponential as support, which we have done. The 200 exponential is already angled to the upside. So we broke down below it. We tested it once. We got rejected to a higher low. We tested a second time, got rejected to a higher low once again, and then we were able to break through them both. So now, the same way that this is a reversion to the mean, a retest to try to break to the upside, once we do break to the upside, we expect it to come back down and retest that was resistance as support. And that's what's basically taking place right now. We're retesting it as support, and now we're starting to move back to the upside. So if this continues to rally over the next couple of days, it's still going to look very bullish. At this point in time, the jewel thief, we basically just broke above into the bullish control zone. We came down and retested right here. If we would have broke below this, we would have lost the red highlighted area and left the bullish control zone. But the bulls obviously still very much in control, and we have started bouncing back to the upside. The pink stochastic angled to the upside, the knife angled back to the upside, the blue angled to the upside. So at this point in time, it looks like we're going to get another push here. Now, where does that push take us to? You know, there's multiple ways we can determine it. So don't mind what's going on here. We obviously have a bunch of different measured moves and, you know, ideas of where we might be headed to in place currently. You guys know that my macro target, I mean, we basically have hit quite a few of our targets, but we still have some further targets to the upside. Now, what I want to look at right here is, and I'm not going to delete all this stuff on this chart, but there's obviously a ton going on. I just want to look at our Fibonacci extension from the top of this first push up here to the bottom down here of our retracement. And obviously that was 2 key fib levels, but now we can kind of get another target to the upside, and we can see where the 1.618, my most common target, is right at like 2.34. So we can kind of have an additional target to the upside, something else to pay attention to. But at this point in time, we have plenty of targets. We're just stair-stepping our way back to the upside. Still very much bullish on this, depending on the different time frames and depending on where we're going to actually like top out and everything. You know, we'll have to wait and see. Is it a possibility, though, that after this 40-year downtrend from the 1980s, that we may actually be breaking out of this trend? I mean, it's definitely possible, but I don't want to get overly excited on it for now. But when we look at the monthly chart, it definitely gives us a different picture. I mean, we have a bunch of green histograms. We're above the slope line, and it is basically flat, about to turn blue and back to the upside on the monthly. We're in the bullish control zone on the monthly, and we're still very much moving to the upside. And then we've crossed 821 back to the upside as well. So at this point in time, the number one target, the most reliable target where I'm expecting yields to go to is 2.684. So, and you know, we can't make presumptions about where the actual Fed funds rate will be in comparison to the 10-year Treasury, because essentially it's been at zero this entire time right here. So part of this is obviously the market pricing in where the yield's going to go, etc. But I don't think it's unrealistic to think that if the Fed funds rate is up at 0.5%, 1%, that we could be at 2.65% on the 10-year Treasury. So, you know, we'll wait and see. Obviously, we can only, you know, estimate right now. But as far as I'm concerned, still very much in a downtrend, but in a potential reversal or having a reversal on the short and longer time frames. So now let's look at oil. So oil obviously broke out of the ascending broadening wedge, started to make a pretty aggressive move back to the upside. And now we see here a couple things have taken place. So we see this is our high here from the previous peak, and now we have clearly put in a lower high. Now the knife went through the roof, obviously telling us that this was unsustainable, and, you know, started to come back down, telling us that this trend is probably over, topping out, or has already topped out. And then obviously from our high here to our high right here, we have a lower high, which gives us bearish divergence as well, obviously between this low peak right here and this parabolic peak here. But the key is that when we broke down right here, we just came back and retested that key Fibonacci level. Let me do this again. You guys know this is my least favorite chart to look at. So if we look from the previous high and we take it down to our low, we basically burst to the upside, and then we had this same resistance in place that we have run into a bunch of times. And now essentially what we're doing is we're just retesting that breakout as support. So we broke out from that level, we came back down, we retested as support. If this area holds, I will expect continuation and the measure move to play out. If this area doesn't hold, we could easily break back down, come back inside this range. This is all going to be, you know, based on essentially, you know, what happens with the news, what happens with the war, all that good stuff, you know. I mean, if we have Iran opening up additional, you know, providing additional barrels, whatever the situation is, we work something out with Venezuela, you know, you're going to hear some big news or whatever, and it's going to line up with exactly what happens on the chart. I don't know what's going to happen right here. What we predicted, what we knew, what we were positioned for this entire time was a massive energy spike, because we know that's an important part of essentially, you know, a cycle topping out and the recession to come. So as far as I'm concerned, it doesn't matter what happens now. We can continue to the upside for a little longer. We can break down from here, and that was the top of the energy or of the oil trend. It really doesn't matter. The fact of the matter is what we expected to happen already took place, whether it's not quite done yet or whether it's completely finished. We know what's coming afterwards. And that's the most important thing because, the same way we position for uranium, the same way we position for energy and commodities leading up to this, now it's time to position for what's next. And part of that was the gold miner trade. Part of that was the energy trade. Part of that was, the uranium, the XLE, whatever, however you decided to play that trade is fine. But now we have to figure out what comes next. And that was one of the questions actually from the group this week was how do you position yourself, for a recession? What's the best case scenario? How do you prepare yourself, protect your capital, and then come out of it ahead? So we're going to talk a little bit more in detail about that. But first I want to continue down the old list. So next we have the VIX. Obviously we have the VIX breaking out positive right here, the ascending channel. We have come all the way back up to the top of the channel, and now here we're pulling back. I expect us to come back down somewhere around the middle. Obviously this will give us a little bit of relief on our traditional markets. We see like some nice little moves in stocks. We see people every time we get any kind of dead cat bounce, you're going to see a 5%, 7%, 10%, 30% rally on these things, and it's going to look huge because they're only going to show you the day or the week or whatever chart makes it look the best. But it's important to remember that when some of these things are down, 50%, 75%, 80%, some of them even, Zoom is down like 85%, and that was one of the big pandemic plays. We have all kinds of big things like Facebook, PayPal, lots of big name market movers that are down 25, 30, 50, even more percent from their highs. So a little 10% move back to the upside after you're down 50% is nothing. It's literally nothing because you're still going to be down substantially from that all-time high. So make sure you zoom out and look at the big perspective and don't think, oh, it's a 10% move, let me buy into momentum, because you just get trapped buying the dip, buying the dip, buying the dip. Obviously, it's not financial advice. I'm not your financial advisor. Markets are extremely volatile. Please do your own research. Trade responsibly. But we know when we get to the top of the range on the VIX that we expect it to pull back down, cool back off for a little bit. But since we have broken out of this long-term trend, we do expect this to go higher. And the measure move of our channel right here is going to take us back into the red zone. Which in my opinion, I think we're going to end up back in that zone because now I think we still have capitulation to come. I don't know if it's going to drag out over years. I don't know if we're just going to get one big sell-off all at once and everyone's going to get super bearish and there's going to be some kind of news that corresponds with it. I don't know how it's going to happen. I wasn't expecting us to get out of the lows, of Rona that quickly. There's no way that anyone can anticipate what fiscal and monetary policy are going to do. I do know that because this is, an election year for midterms and everything, I know that it changes a lot of stuff because we're less likely to get that same sort of, stimulation from the Fed or from the government because the Fed wants to look like they're not being biased one way or the other, Republican, Democrat, whatever. They want to kind of just stick with their plan and not look like they're playing favorites because obviously they're not supposed to be, political. So they're more likely to not make any extreme moves to one side or the other as to remain looking biased at least. And the same way, obviously we don't expect to get much out of, the government because essentially now there's less incentive for the Republicans to work with the Democrats because they don't want the Democrats to get anything done because they're, coming up on midterms. They don't want to help the Democrats out. So I would expect basically just a stalemate for the next 3 months, 6 months, 9 months. Now, there's certain things obviously they're going to agree on, war spending, all kinds of like, hey, we need to, keep the government funded, whatever, garbage like that. But as far as new stuff, as far as getting things accomplished, I don't see it happening. And then, statistically speaking, and you can see the obvious sentiment in the United States, more likely than not, the Democrats are going to lose control of, Congress. So at that point in time, I don't know if it's going to be the House. I don't know exactly how things are going to turn out, but in all reality, we know at this point in time, it's basically a 50-50 and Kamala Harris is the deciding vote. So in all reality, We know a bunch of Democrats not even running again. We know that a lot of people are shifting towards Republicans just because of the way, things are just falling apart. And statistically speaking, even if it has nothing to do with the Democrats, we know that statistically speaking, the Republicans will then, win. So it's the same way that if it was the other way around, but this is basically just Obama 2.0 as far as I'm concerned. So I don't expect anything to change. I don't expect there to be, some crazy fiscal or monetary policy that gets us out this time until we reach some ridiculous extreme. And I think in order to get to that extreme, we're going to have to see volatility basically through the roof. So I fully expect us to get into that red zone. So here, let's look at the Dow Jones, and we can actually illustrate my point right here with the Dow. So from the peak to, basically, let's say this recent low of yesterday, we're down 12%, 11.79%. And then, of course, we bounce from the low, up, and everybody's ready to call the bottom again on a 2% move back to the upside. But we're still down 9%. So it's not like this is just some bottoming thing. I mean, how many times do we sell off, have a nice move back to the upside, and then just put in a lower no? Have a nice move back to the upside, and then we just put in a lower low. So more likely than not, in my opinion, we have basically just started into a bear market. So the most obvious, the most likely, the most realistic situation to me is that we have broken down from key support levels, and we're just coming back up to retest it before a continuation to the downside. We're going to get oversold in a bear market or in a sell off. We're going to get overbought in a bull market. Doesn't mean that has to be the top or the bottom. It just means that we're going to see that dead cat bounce or reaction rally. And that's why slinky theory, we always talk about it, is so important, because you're going to have moves to the downside. You're always going to have move back to the upside. But then what happens after that? Do you put in a new high or do you put in a new low? And that's where the slinky theory comes in. You go down the stair, the back end of the slinky swings back up to the upside and then goes lower. And then it hits the next stair, and then the back end of the slinky swings back up and then goes lower. So that's what we have to pay attention to and make sure that that's not what's taking place. So as far as I'm concerned, that's what it looks like to me. The S&P still has not technically confirmed the 200 simple into a downtrend. But again, until we actually get back above 445, we're still on the SPY very much in a downtrend. And although we didn't put in a low here, technically, the same way we did on the Dow Jones, this doesn't look any better to me, honestly. And I think we still see continuation. And as a matter of fact, we're not even closing above the 8 moving average. And we know for a fact that if you're sitting on the edge of your seat or sitting on your hands and you're just itching to get back into these markets because you don't want to miss the bottom, you don't want to miss the next pump, you're anxious, just remember, I share my strategy with you guys completely. You can do whatever you want. It's completely up to you. But by sharing my strategy, my point going over and over again with the same things is that I'm showing you that I have definable ways to know whether or not it's time for me to get back into markets, whether I want to buy right now. Sometimes I could dip my toes in. Sometimes I'll take a little swing trade or a little scalp trade. In the meantime, maybe I'm impatient and looking for a trade setup just to make a little trade or just to make a little money or whatever. That's completely fine. But as far as actual positional trading, we know that in order for this market to ever be in a bull market again, in order for us to be bullish on this market again, the first thing that needs to happen is we need to see this 8 and 21 cross back to the upside. So right now, the best case scenario, assuming right now that was the bottom, that was it. We hit the bottom right here. We came back down. We put in a higher low. That was the bottom. Okay. Time traveler me comes back in time and goes, we just put in the bottom. And I go, okay, great. Thanks for letting me know. So you're going to enter now? And I'm like, well, I'll probably just stick to my trading plan. Oh, okay. Well, time traveler me says, well, how are you going to know when to enter? Well, you guys know already. As soon as the 8 crosses back above the 21 and this flips green, that's our first potential entry point for the retest back to the 200s. Now, we just happen to be right underneath the 200s, so that move is not going to be very big. But assuming, it flips green like this, we cross back up, we retouch the 200 exponential, 200 simple, we bounce around for a little bit, and then we actually get back on top of the 200 exponential and simple, we're bullish again. That's it. That's all it takes. But we know that there's basically 2 or 3 steps that happen here. The 8 and 21 cross to the upside, that's 1 step. We get back above the 200 exponential and simple, that's 2 steps. And then the 200 exponential and simple are blue again. That's the 3rd step. And then we're net long again. We're ready to go. I mean, that's it. And it doesn't have to be the bottom, but as far as I'm concerned, Once that happens, the 821 cross back to the upside right here. That's where we get bullish a little bit. We retest the 200 exponential on simple. We get back above them. That's where we get bullish again. And then they flip over blue. So that's it. You know, we typically will get that final reversion to the mean retest. And then after that, it's off to the races. And then the final step is when the 200 exponential crosses above the 200 simple. And that's just based on the moving averages on a daily time frame, something nice and simple that we can know no matter what, whether we're right about prices going lower, whether you know, we decide that the bottom is already in, no matter what, we have a clear, definable way to where we know when to enter back in. We don't need to pick the bottom. What we want to do is, and this is another really important thing too, you know, if you made the perfect trade and bought the absolute bottom, you bought right here, you got in 20% sooner by picking the bottom. But there was almost no risk when you took the 821 cross to the upside. And then, you know, at that point in time, you basically capture from the 821 up to the 200 exponential another 15%. And then if you played it the absolute most cautious and you didn't take any chances and you just waited till the 200 exponential and simple were blue and we're in an uptrend and everything was confirmed, and then you rode it all the way to the top and then you didn't take any of the 821 signals, you literally just sold out once we crossed below the 200 exponential and simple, you know, you basically made 50% gain. So sure, you make a little more if you pick the bottom, but you also have the chance of getting caught in a trade upside down in an uncomfortable situation. So it's okay to enter a little position, you know, when you think the bottom's in. It's okay to enter more of a position when you get the 821 cross to the upside. You know, you definitely want to enter into a position once you're back on top of 200 exponential and simple. And then, you know, obviously you want to be fully positioned or, you know, majority of the way positioned once the 200 exponential and simple are sloped to the upside. But the goal is to mitigate risk, one, and two, capture the majority of the move to the upside. And that's what this strategy, specifically just using the moving averages, is all about. So as far as positioning, when we know if we're right, when we know if we're wrong, when we know to get back in, you know, that's it. I will take an initial entry. Say we're going to divide our account up to 4 pieces, and we're going to enter based on 4 triggers, whatever they are. The first trigger will be the 821 cross back to the upside, green. The second trigger will be once we're back on top of the 200 exponential and simple. The third trigger will be, you know, once they are both crossed back to the upside, blue. And then the fourth trigger would be once the 200 exponential is back on top of the 200 simple at that cross. So, you know, whether you want to do it 25% at a time, whether you want to do 10% in the beginning, 10% at the end, and then 40% in the middle at each of those triggers. That's how, you know, I like to do it, depending on what market I'm doing, depending on how I'm looking at it. And then obviously I'm not just going all in on the S&P. I'm doing it with a bunch of different assets or sectors, etc. But that for me is the simplest, most consistent, most rewarding way to position yourself. Now, the best trade you ever make is going to be when you buy the bottom and get lucky. The best trade you ever make is when you sell the top and get lucky. That's going to be the best trade you ever make, the most exciting, but it's never going to be the biggest positions. It's never going to be the biggest monetary gains. It might be the biggest percentage gains because you got the absolute top or the absolute bottom, but it's also not consistent either. We talked about it last week. If we're in a run for 2 years straight going to the upside and we try to pick the top on a daily candle, we have 2 years straight. There's 350 days in a year. So we basically have 700 days. We're going to try to pick 1 out of 700 candles. The likelihood of picking the top, even on a weekly chart, is very unlikely. So that's how I like to look at it. And the same thing on the Nasdaq here. So obviously the Nasdaq is much more bearish. This is the worst of the main indexes. Well, arguably the Russell. I mean, let's just put it this way. The S&P is the best right now. The Dow Jones is next. And then the Russell and the Nasdaq are both pretty trashy. So, if you were in the Nasdaq, you made more gains to the upside, but it's the deepest correction right now. So we hit over 20%. So as far as the market's concerned, we entered into an official bear market, on one of these last couple candles. As far as I'm concerned, the 200 exponential and simple are slope back down to the downside. Again, if you're worried about buying the bottom on the Nasdaq or whatever, you can do whatever you want. But a lot of times these things will go down 50% and then they will go down another 50%. So you got to be real careful because they can keep just getting cut in half indefinitely. It never has to end. If you are a mile away from someone and you say, okay, I'm going to meet you halfway, stay where you're at. And then you go halfway to them And then you say, okay, I'm going to come halfway, stay where you're at. And then you go halfway again, halfway again, halfway again, halfway again, halfway again, halfway again. You'll never actually reach that person because you're just cutting the distance in half over and over again. So you can have indefinite amounts of 50% drawdowns in something and it never actually goes to zero because by the end, you're just trimming pennies off this thing. So just remember that buying in low after something has already gotten a serious haircut is not, in my opinion, that is not a good strategy. You need to have some kind of level you're buying off of, a support. You need to have a moving average cost. You need to have some reason that you're buying something at a level, not just because it's down 50% or 25% or 75%. You know, and again, that's my opinion. You can do whatever you want, but things can indefinitely take 50% drawdowns and never actually go to zero. So for IXIC, for Nasdaq, we basically have just come back up and retested some of this key resistance. We obviously still have some support at these levels. We started tagging some key Fibonacci's. We basically just, came back up above the 236 and we're hanging on to it for now. I still think we're headed back down to the 382 and then obviously 200 exponential and simple still slope to the downside. Before we can ever even begin to get bearish on this, we have to get, or bullish on this, we have to get back above 13.5. Because that would potentially give us an 821 cross back to the upside. Then we can, again, target like 14.4 or we can target 14.7. Once we get back above then slope flips back to the upside. We can start looking for upside potential targets. But, when does that happen? Well, we know in order for that to ever happen, first thing that has to happen is the 821 cross back to the upside. So Russell, again, just looks like absolute trash. Broken down from key support levels. Now, it does look like it's trying to retest 821. It failed the last 2 times. And I know people are saying like, oh, small caps, they're going to lead us out of the bear market. It's all about the small caps. They've been underperforming and, the growth and the potential. And I just don't buy it, guys. I really don't. There's no reason for me to get bullish on small caps fundamentally or technically. I mean, this has been the biggest underperforming index throughout this entire bull run. So if we just have the most epic bull run in existence and everything into the future looks like it's going to be worse earnings, worse profitability, sales, whatever you want to look at, whatever metric, worse economy, worse GDP, worse, regulations by the government, fiscal, monetary policy, whatever you want to say, worse taxes, everything in the future, as much as it sucks to say, short term to medium term, it looks like it's going to be worse. The future does not look like it's going to be better next year than it was going into like 2017, 2018, 2019. So in my opinion, no reason to be like overly ambitious about the future. And that tells me that the likelihood of this performing well, not that good. Not that good. Most of these are zombies. Interest rates probably going to be more expensive in the future. Taxes probably going to be higher in the future. I just don't see it. So, if we get an 821 cross back to the upside here, sure, we can make that play. But we're, it's in my opinion, a bear market rally to retest the 200 exponential and simple before likely selling back off to the downside. We'll see what happens, obviously. The Russell has already come back down and hit the 236. We were talking about a potential retest that got rejected right here before it ever got to the 2130 level. It's possible we still get that, but I do still expect further downside potential. So don't want to get too excited after just one of these little pops up. And I mean, look, how many of these do we have so far for people to be once again out here calling the bottom? I mean, we had a pop right here, came back up, came back down again, had another pop. It was like, this is the bottom, this is the bottom. Came back down, pop up, this is the bottom, this is the bottom. Then we come back down to the low, this is the bottom, this is the bottom. I mean, it's just the same people will be calling for this is the bottom the whole way down, the same way that the bears were calling for the top the whole way up. You listen to the same people over and over again, and then eventually you say it enough times and you're right. And then they're like, see, I told you that was the bottom. Don't listen to what they say, listen to what they do. So XLE obviously been overperforming. It's basically been the only sector, the only index that was going to the upside lately. And then obviously we had a pretty big indecision candle right here. And then we see it back down, retesting the 821. I'm not convinced energy is done. I'm not convinced the trade is over yet. But I do know that this is a nice area to be taking profits, to be looking at, potential. What I see this little pop was in the market recently is we had a huge run up in gold. We had a huge run up in a lot of other commodities in, the energy sector in general, in oil, in all these things. So as far as I'm concerned, I think a lot of people just cycled some of that back out and then went in and bought up a bunch of, beat down tech stocks, a bunch of things that have been selling off aggressively. You know, if one thing pops up 20% while everything else is going down like 20 to 50%, you just basically rebalancing into some of those things that are massively down by selling some out of your winners that are either too large a position in your portfolio or had some epic run, and then you're just buying a couple things that are undervalued and just kind of balancing back out. That's how I look at it. I think that's what this most recent move was. But we came back up, we retested the 786. You know, in my opinion, we probably continue to the upside right here. Even if we cool off for a little bit, I think we probably just come back down. The most important thing for us to pay attention to is, you know, essentially the trajectory. Is the trajectory still moving to the upside and aggressive, or does it look like it's starting to fade? And the best way to look at that is just look at a longer time frame. So right now, you know, this monthly candle, obviously we're going parabolic right now. We're at a key resistance level. We've been talking about this resistance level. You know, I told you guys I was expecting the top to be around this area, at least short term. I would not be surprised to see a pullback to like that 65 level, but I will look at that as a buying opportunity because I don't think that energy all of a sudden is just going to get cheap and it's all going to be over. But again, on the weekly, or I'm sorry, on the monthly chart, we're very much in the bullish control zone. We have very much strong trend to the upside. We're at like some of the highest levels we have seen. And each of those times when we got to these levels was some massive peak. Now the difference is what we have to look out for is, are we at an area like this where we're peaking out and then we're just going to go much higher over time? Because if you were watching this at the time and then it started to sell off, you might think all these monthly candles in a row, that was the peak. And meanwhile, it still kind of crept higher and then eventually shot up another, you know, 50% plus to the upside. So we don't want to get completely out of these positions, but we also don't want to give back all of our gains because we were greedy. We could easily have a situation like this, though, where it peaks out, sells back off, gives back a ton, and then just continues to the upside. So that's what we're looking for. We're looking for, is that going to be one of those situations where, you know, if you took profits already, took some off the table, you know, from the top just back to like the moving averages, you're talking about a 20% pullback, a great buying opportunity, 30% pullback, even better buying opportunity. Do we get there? Who knows? But we do know that this is a key resistance level that has acted as resistance many, many times on the monthly chart. So, and if you don't want to look at the monthly chart, we can look at the weekly chart and we can see once again, you know, we're very much in the process of confirming a bull market. But what happens almost all the time when we confirm into a bull or a bear market, we almost always break above the 200 exponential and simple. We flip the slope over blue on both of them, and then we come back down and retest them to make sure it's going to hold as support. That's just the market double checking to make sure this is the real deal and it's not going to break, lose support, and then they're just going to get trapped in some position upside down. So in my opinion, XLE could easily pull back to like 55, 60 level. We could easily have, I mean, some of these oil prices, you know, nat gas prices, uranium prices, some of them are through the roof. The amount of gains so far, a lot of people are going to want to take it off the table, you know, so not unrealistic to think, especially as we get towards like the end of March, that we could potentially have a nice pullback to some of these, a little rebalance, and then another rip to the upside. So transportation sector obviously has been getting crushed inside of this descending channel. We bounced the bottom of the channel, coming back up, you know, still very much below the 200 exponential and simple. We know transportation topping out is one of the main things we're paying attention to, as that typically almost always precedes a recession. So all four of our recession indicators are screaming right now, recession is coming. Well, you know, mainstream media, you know, financial analysts, talking heads on, you know, whatever financial channel you watch, etc., are all saying, we don't see a recession coming, the economy is strong, you know, etc., etc. It's obviously it's bullshit. You know, are they lying? Are they just in a bubble surrounded by other people that don't live in reality? Maybe both. Keep in mind, a lot of them are heavily invested in these markets, so they have a vested interest in, you know, telling everybody that it's rain while they're pissing on them. XLF basically just reclaimed the bottom of the channel. We spoke about this a little bit. Essentially, our target to downside was obviously this breakdown to support. We didn't quite get there. We basically reclaimed the channel now. So again, you know, this little breakdown right here doesn't invalidate this channel. The fact that we reclaimed it as support, I wouldn't be surprised to see us come back up to like the heart line here, but I do expect us to continue operating inside of this channel. Now, if this area starts to fail and we break that back down again, you know, we'll invalidate the channel, we'll get that out of here, and we'll just start paying attention to, our next targets. We can start basically fibbing from the bottom of the range up to the top, and start paying attention to like these key levels. But obviously the 236 is our initial target to the downside. But before we get there, we have a very clear, resistance level through here, which acted as support when we got back down to it right here. And then again, we almost made it there, not quite. A little bit of a front run taking place. That's fine. We expect that to happen. But overall, we have confirmed into a bear market on the financial sector. So again, we expect always that reversion to the mean. A bunch of people, what happens with these reversion to the mean plays is the people that are wrong, the market makers, the whales, the bots, the algos, whatever, as this switches from a long-term uptrend into a confirmed downtrend, the reversion to the mean play is basically them just pushing the price back up so that they can exit at break even. Because what happens is we pull back down to the 200 exponential and simple. That's a buying opportunity. So they buy, and then the area breaks, and then they say, oh, we were wrong. So they push the price back up here, and then they exit and push back into it. People buy into the FOMO back to the upside, and then it continues to the downside. So that is the psychology or the mentality behind these. Oh, and by the way, too, for the group members, I know a lot of you guys are here now or will watch this later on. I did add a tab into the group as you guys requested for like books and everything. I'll list a bunch of books on there and then just like a short little description or synopsis or whatever of the book, who it's good for, and then like my personal, like, I don't know, like 1 out of 5 stars, how good this book is or how important it is. So expect that. Obviously the tab is there, but I'm going to start putting those, and then other people can add too. If you have like a good Substack or, there's other good publications or links that are constantly uploading like nice, useful information. That was one of the group members' requests, and I think it's a great idea. I've had quite a few people request books before, and I've typically just given them like, just given them as requested. But I definitely think that's a key resource that will be on there. So I will start building on that soon into the group, but you guys obviously feel welcome as well. I'll kind of set a, standard by just putting, a couple things on there, and then you guys can kind of just follow that template, as I do want just not a straight up just list of books or list of people or whatever who you should read, but like, a little description essentially saying what it is, why it's important, and what kind of quality it is or relevance or whatever we decide to put. So but anyway, it just made me think of that. So so XLF, again, just coming back up, retesting those levels. And the reason it made me think of that is someone asked about like trading psychology or psychology of the markets. And that's the psychology behind the 200 exponential and simple, or, SR flip. You have support, you come back down, you buy support, support fails. So then you push the price back up, you sell support, and then you continue lower. It's basically saying, oh, I was wrong. Let me get out of this position, break even, or closer to it at least. So XLC, communication. So obviously we had a nice move to the upside here, been following like parabolic trend. It was slowly starting to top out, and then we started to put in lower highs, and then again lower highs, and then we started to get like that bloody waterfall basically. So from the bottom Fibonacci to the top, we basically came down to 236 initially, had a nice pushback up to the resistance, to the 200 exponential, obviously got rejected at that resistance as well, and then we went much lower. So now we have touched the 382. So again, it would not be unrealistic to think that we get a pushback up potentially back to the 236. And again, it's that same mentality again. People buy the 236, it moves to the upside, they don't exit, and then it gets back down, and now they're upside down in position. So, you essentially pushes back up, or people buy the dip, push back up to the next resistance, and then sell into it, and then it goes lower. And again, that's just that slinky theory. It's 2 steps down, and 1 step up, 2 steps down, 1 step up, 2 steps down, 1 step up, as opposed to in a bull market where we're taking 2 steps up, 1 step down, 2 steps up, 1 step down. So, again, it's just that market psychology. But we did hit a key support right here. I do expect this to continue lower. But for now, obviously, we hit a key level. Anytime we hit a key target, we would expect other market makers or, whales or technical analysts to see those same levels and, potentially be looking at them as a buying opportunity, as a entry for at least a scalp, if not a position. But again, when we see something like this, communication, as one of the worst performing sectors, when we're looking at like just the like the index select sector funds, etc. Whatever, however you're looking at the actual sector of the market, when you see the one that's performing the worst, it just because it has hit support doesn't necessarily mean that's a great time to buy, because you're basically buying like the worst thing. So if it's been performing the worst because it's at like the lowest level, like most everything else is at the 236, we see communication at the 382. So it's like, oh, it's already in a deeper retrace, so it's great value. Well, it's in a deeper retrace because the worst sector. It's one of the worst performing sectors. So maybe it goes to the 0.5 next, and everything else comes to the 382, and then the market bottoms. So just because it was ahead going to the downside doesn't mean it's necessarily a good value. It's just at a key support. But again, that's why I'll look for the main, market indices to hit those key levels, to put in some bottoming signals, and then I'll start like bottom fishing for some of this stuff. But I don't want to just come in here and start buying things because they're at key support if they're like the worst performing sector. So XLP, okay, so we were talking about like recession proofing portfolios and everything like that a little bit, and that was one of the questions that I got in the group. So we'll talk a little bit about that and then take a look at a couple key sectors. You guys have heard me say the same thing over and over again, talking about going into the recession, what I look for as potential early indicators that we're going into recession. You guys know the four horsemen have all. The final one was energy spike. That was it. We've been watching the yield curve inversion. It's all but about to invert at this point in time. We're seeing the transportation sector starting to top out. We're seeing semiconductors starting to top out. And then now we're seeing energy prices spike. And that was the final, horseman of the apocalypse telling us recession is going to happen. Possibly depression, stagnation, stagflation, whatever other word you want to use, doesn't matter. Nobody knows exactly what's going to happen, but we know that probably in the future, we're going to go through some pain when we see those four things happen at once. And typically, when we see the energy spike, that is typically a big end of a cycle. The same way we saw in like 2000 or 2008, or one of these like big macro market tops that last for literally like, years or decades in some cases. Not just like a little, oh, we topped out, we'll be back in a couple months. Does it have to happen? No. But if we know every time in the past we had one of these massive pullbacks, these massive capitulations, these, horrible market conditions that have lasted far longer and not only caused price capitulation, but time capitulation, if we can identify a bunch of things that happened every time before that mass capitulation event, before that extreme pain, when we identify those things, and that's my four horsemen, when we see those four horsemen start to ride, when we see them come in our direction, we know, okay, hang on. This isn't just one of those little itty bitty pullbacks. We're not just going to have a little correction. Maybe it is, but we know when we see those four horsemen ride that those four things always happen before the big capitulation event. So if we see one or two or three of them, it's like, okay, we should pay attention. Danger, it could get bad here. But like when we see that energy spike, we know that that's probably a wrap. And we know we could be wrong about that, and that's fine because we'll be able to reposition. But if it's the other way around, if we just assume it's going to be a little itty bitty pullback and we're just going to have a little, pain, and then next thing you know, we'll be back at new all-time highs, that's how you get trapped for 10 years in a sideways market, or upside down in some stock or crypto or whatever for a 75, 85, 95% downturn, and you just get absolutely wrecked because you got greedy or you got comfortable or confident or you just got lazy. So that's what we're looking to avoid. So one of the recession-proof sectors is XLP, consumer staples, because what is in consumer staples is obviously like staples of existence. So all the things that are in here, or most of the things that make up consumer staples sector, are things that people will need no matter what. So regardless of if we go to recession, what happens when you go into a recession? People are spending more money, more of their earnings on the things that they need, because the things they need are more expensive, or they're making less money, so they're spending a larger percentage. Even if the price is not more expensive for those things, they have less money to spend, therefore they have less disposable income. So the things that they buy with their disposable income suffer, but the things they still need still get bought, whether they're higher prices or whether they're just a higher percentage of your disposable income or of your total income, they still need to get bought. So people still need to buy food. They still need to pay rent. They still need to buy gasoline to get to work. They still need to have internet services. They still need to have working appliances, whether it's a refrigerator, whether it's a stove, whether it's a dishwasher. You know, there's certain things that you need no matter what that just you can't negotiate on. And that's where the consumer staples come in. It's those things that people need in their life that they don't have the same choice to cut out. Like they can just cut out like a fancy watch or a fancy sports car or, you know, an electric vehicle or whatever, you know, consumer like discretionary item versus like a consumer staple item. So for the staples, we know that this stays strong. Now, it does not mean this is not going to go to the downside. You know, it's already down obviously from 78 top right here to 73. But we know what happens is even if this sells off, it's probably not going to suffer the same way. So if you have to be invested or you want to be invested or you want to be diversified, but you don't want to be suffering those like 90% drawdowns, consumer staples is a good place to be. And we could even see potentially this continue to rise, especially if there's inflation and the inflation is putting, you know, if we go into a stagflation situation, we could see something like consumer staples continue to go to the upside and be profitable while everything gets more expensive and we're suffering from inflation. So there's different areas where you get like a stagflation situation, a regular inflation, you know, versus just a booming economy, risk on environment. So in my opinion, XLP, one of the safety places, one of the safer places or the safest places. And we can see that even though it is technically below 200 exponential and simple, for now, it is still actually technically not in a bear market yet. I would not be surprised to see this come down to like the previous support, which was our resistance from before. Would not be surprised to see it down here at that yellow line. But keep in mind here, when we're looking at this, and again, we'll illustrate this again on utilities, which is the next one we'll look at. Even that pullback right there, I mean, we're talking about like a 7% pullback. You know, that's not a game changer. It's not going to wipe you out. Yeah, it's terrible. You know, it sucks. You never want to lose 7% or you never want to be down from the peak, you know, 12.8%. But it's not going to be a game changer. You know, you lost your entire retirement. So that's why XLP is one of those safety plays. So next is utilities. So obviously utilities is still doing well overall. We just put in recently highs. Obviously this is going to have to do with a lot of, you know, energy prices and whatnot at all-time highs. But the fact of the matter is, once again, if we go into a recession and people can't just buy whatever they want, they don't have the same spending money, what do they still need? They still need utilities. You still need running water. You still need electricity. You still need natural gas to run your stove or heat your home or whatever. You still need certain things. And that's why the utilities are so important is because the same way you have like your consumer staples that people will still need to spend on whether they want to or not, whether the prices are higher or lower, they still will need them. It's just maybe they have to buy less of them, or maybe they have to buy an off-brand or a cheaper version, or, you know, seek out similar alternatives. They still need them. So in many ways, utilities is similar in that same way. So again, if we see another pullback on utilities or something like that, you know, where's it going to go back to? Well, we already pulled back to that key resistance here in yellow, which is that previous top. So maybe we come back down to this green support. Maybe we come back down to 200 exponential and simple. But again, you know, from the top right here to where we're at now, it's down 3%, but it's from the all-time highs in the last couple of days. 7% if we come back down to 200 exponential and simple. You know, 9-10% if we're back down at like this ascending support line. And we would expect this channel to hold. Let's zoom out here for a minute. We would expect this channel to hold until it doesn't. So I fully expect this to continue holding. Now, granted, the entire way up here from 2008, the majority of the time we spent in the top of the channel. Okay, so obviously that's the more bullish area to be, but still inside the channel. Since then, we hung out for a long time in the bottom of the channel from like that 2018 like kind of peak right here. And then we moved all the way back up and spiked in 2020, came all the way back down. Now, obviously we had a capitulation level event, a break of the channel, measure move, and essentially came down to 200 exponential. But now we're just operating in the bottom of the channel. So again, I fully expect us to just stay inside this channel. We have, you know, the likelihood of breaking down from this channel, extremely unlikely. When it happens, it will be a one-time event. Obviously, part of the reason of this was fear. Part of the reason of this was, you know, just overreaction or capitulation. I don't expect another event like that. If it does happen, it's definitely possible. But, you know, even at some crazy capitulation level event like this, you're still doing exponentially better than like a Cathie Wood stock or something like that. You know, we're talking about like an 18% move down. If this thing just absolutely cratered tomorrow, we're talking about a 31% move to the downside. Don't think it would happen. But again, this is where you're going to find protection, but still be invested in these markets in the same way that, you know, you would see in something like consumer staples. So utilities is our next one. And then, you know, real estate in general, or XLRE or something similar, like a real estate fund, something like that. Again, people need places to live. They need houses. You know, the real estate market tends to lag behind. So even if it only offers protection, if we go into a recession for 1 or 2 or 3 years, it will often lag behind enough that you'll be protected for the first few years, and then you can reposition out of it before we get like a full-on like housing meltdown, if that should happen, if something continues on long enough, like we saw back in like 2008 to like 2011, 12, something like that. So, you know, essentially this lags. It will protect you for longer in those situations. People always need somewhere to live. So the same way that the other ones are a necessity, I expect real estate to be the same way too. And then obviously, I don't think that we're going to see, because rates were so low for so long, and we may potentially, I'm not saying it's a fact, but we may potentially bottom out rates. You know, rates have been going down for, you know, basically 40 years and essentially hit zero. So we may see lower rates again in the future. We may see negative rates. Anything's possible. I don't think it's likely though. I think it's more likely that rates go higher from here than lower from here. So if you have a mortgage in for a single property that you live in, or a bunch of investment properties that you rent out, the likelihood that you will sell those properties and buy something else, get a new loan for something else at a higher interest rate, is very unlikely. It's very unlikely that people will sell and move into a different property with a loan. Now, there's still going to be some people that sell because the prices are so high, and then pay off the loan and then don't buy something else, or wait for the market to, you know, go down and look for some value or whatever. There's always going to be some buying. There's always going to be some selling. But the incentive of people to sell when rates were at all-time lows and valuations were at all-time highs is extremely low, in my opinion. Because going into the future, you're not going to be able to pick up another loan for a super low rate like that. Even if the valuations come down, you're still probably, unless you literally just bought the absolute top after a multi-year, you know, bull market in real estate, unless you bought the absolute top, you're never going to go underwater in a mortgage. I mean, I shouldn't say never, but, you know, if you put down 20% on a mortgage, you've got a 30-year mortgage at, you know, essentially like 3% or something like that. You're not going to be upside down on that, because the house probably appreciated, you know, 20, 30+% in the last year or two. So if you have 20% down and the house is worth 30% more, you know, you're somewhere around like, you know, 40, 50% equity in that house. So the house would literally have to drop over 50% in value. So if the house is now worth, you know, $1 million and you paid, you know, 600,000 for it or something like that a few years ago at a 3% low rate, and you put, you know, 120,000 into it for the down payment, I mean, the house now has to drop from that $1 million all the way down to 500,000 to get to like your break even point, not to mention you've been making payments on along the way. So you have enough equity in that house that you could stomach a 50% drop before you're underwater on it. And then even then, if you said, oh God, I got to get out of this thing before I go negative, you sell it and you still can pay off your mortgage. Where the issue come in is where people buy something for an inflated value, don't put down a big down payment, and then the prices come down on it and they end up negative with negative equity. You see it sometimes with people with cars too. They'll pay way too much for a car, and then the car breaks down, and then the dealership will say like, push, pull, roll it in, and you know, we'll take care of your loan for you or whatever. And somebody gets like, you know, $3,000 for their car, but they still owe $7,000 on it, and the dealership will say, don't worry, we'll take it off your hands, and then we'll just roll it over into your new loan. And what happens is, you know, they give you $3,000 for it, you owe $7,000 on it, so they just put that extra $4,000 you owe onto your new loan for a new car, and that just incentivizes you to get the new car. But that's your negative equity on that car. You would still, the alternative situation is you sell the car on the free market for $3,000, you still owe $7,000, and now you have a $4,000 loan payment every month for something you don't even have anymore. That's what happened previously in like the 08 financial crisis. The that basically put people in trouble, where there was all these defaults on the houses. They owed more money than the house was worth. So if they took the house, sold it on the open market, and the house was worth $250,000 now, and they had a $300,000 or $400,000 loan on it, they would still be making a house payment, but not have a house anymore. So they would just default, and then they would just squat and run it down, or stay there, or just disappear, and then they would just wreck their credit. The house would be in terrible shape by the time somebody got it. By the time all the proceedings went through, it's been 6 months, 9 months, 12 months since the default. So now nothing's been kept up. Maybe they stripped all the copper, pipes out of the walls, like all kinds of just horror stories of these situations that happen. We're not going to see that happen because people aren't upside down in all these houses. So in my opinion, real estate, while it may not be the best investment right now, and I think we're seeing a legitimate change in the way real estate is done. One, because of demographics. Two, because of more people working from home or working outside of big cities. So they're leaving big cities with decent amounts of money and then buying up houses in like rural areas, etc. And then also just corporate real estate in general. I don't know that we see a situation where you ever have 95% of people that are working in the office. We'll probably see 75% back in the office. A lot of people will want to be in the office at least a few days a week, or businesses will want people in the office a few days a week to bounce ideas off each other's heads, to make sure everybody's working hard, to make sure they're getting their money out of their places, their leases, their business. Maybe they want to make sure people are motivated or having like social interactions. Whatever the case is, I don't think commercial real estate goes away, but I think we're going to see a revaluing of commercial real estate. And I mean, that's no secret that commercial real estate is probably going to do horribly going into the future. But the fact of the matter is we may see some of that off balance in the corporate commercial portion of real estate move into, people's homes. So all of a sudden now, because people aren't going into the office all the time, maybe they want to have a little nicer of a home. Maybe they have a little more money to spend on their home. Maybe they can work in a different city where houses are priced more reasonably. So it's going to drive up the median or the minimum house price permanently in that area, because a bunch of people from New York moved to Florida, or a bunch of people from California moved to Texas, or whatever the situation. So a lot of it's demographic, a lot of it's geographical, a lot of it also will be foreign investors, especially in the United States, wanting to come into where like real estate's safe, where valuations are safe, but maybe the markets are too volatile, etc. So again, I think real estate is one of those, historically, it's one of the safer places you could be. Now, there's a couple other things too I didn't pull up a chart for specifically, but another big thing is obviously cash. We always look at the DXY, compare it to the basket of currencies, or talk about like where you would want to have your money, what currency, whatever. Cash is always a good place to be. The DXY is very strong. So in my opinion, US dollars is a good place to have your cash, because it's going to maintain your buying power. And then at the right time, maybe you want to swoop into some of these foreign currencies, whether you're trading like Forex, whether you're just looking to invest in, emerging markets or China or Russia, whatever it is that you're waiting for this opportunity to do, it will typically protect your cash better than the other ones. Now, if inflation still goes through the roof, if we still see consistent inflation going into the future, keep in mind that every year you're sitting on that cash is probably costing you something like 7%, of your buying power through inflation. But if everything's going down at 7% or faster, you're still gaining relative strength. Now, gold is another one too, or silver, or commodities, or whatever. Now, when I talk about gold, a lot of times, remember, I'm talking about commodities in general, and I use gold as a proxy for all commodities, because you can't just buy a silo of corn and store it for the next 20 years and just have all the corn you're going to need for the rest of your life. You can't just buy a bunch of wheat and just have bushels of wheat in your backyard, and then when you need some wheat, you can go get it. Or you can't just buy, 1,000 pounds of coffee and say, well, I'm never going to need coffee again. I drink a lot of coffee. I went ahead and just bought it all right now, and I'll just use it for the rest of my life. I'm a genius. You can't do that. So what people do is they buy gold, and that stores their value indefinitely, because it's literally like the hardest money you can have. And then they turn around and know that that gold, compared to the rest of the commodities, whether it's coffee or wheat or whatever it is probably going to hold that relative value very closely. So that's why people call it a quote-unquote inflation hedge, and that's why people use it as a proxy for all commodities, or I do when I speak about it. So obviously we've seen gold like surge over the last few days, retesting that all-time high, and basically maybe it's not doing as well as something like nickel that just spiked or whatever, or something like, soybeans or whatever, something that's hitting like new all-time highs. But overall, historically, on a long enough time frame, we know that there are like historical average ratios that gold will have to those things. So if you look at like, whether it's the Dow Jones, whether it's corn, it's wheat, it's, silver, there's historical ratios that you can compare, and you can see typically within a couple standard deviations that gold will hold its value. So gold is another one. And then the final one I wanted to talk about is, things that pay you to own them. So for instance, real estate is one of them. If you own a house and the house goes down in value, but you're locked in at a super low rate, but you have someone paying you, rent to live there, it's paying you money to own it. So that's not necessarily a bad thing. So regardless of what the actual value of the house is, if you're not planning on selling the house, who cares? If the house is worth, $1 million and someone's renting it out from you, and then you look at the prices on Zillow, a year from now, and it's only worth $900,000, but someone is paying you $2,000 a month to live there, who cares? It went down $100,000 in value. Sure, that sucks. Okay, but you're not going to sell it. So why does the value matter? Well, it doesn't. So if someone's paying you $2,000 a month to live there, you made $24,000 and you're not planning on selling it anyway. So you're just looking for that income. You're looking for that steady, you're basically just having them pay your mortgage for you. And then eventually the mortgage is paid off and you own it, and it's still just paying you to own it. So things like that, always good. Dividend stocks, the same way too. If you have a bunch of principal tied up in a dividend stock, something that's paying you a nice dividend. I mean, not just like the S&P, like, 2.5%, whatever. If you have something that's paying you like a nice 5, 6, 7% dividend that has an amazing dividend history, it has paid consistent dividends for 50 years straight and, never missed a payment, the actual price or the value of the stock is less important than the dividend, because you're looking for just that payment, that steady dividend payment, paying you to own it. Whether you reinvest those dividends, whether you're living off them and you're retired, etc. But dividend stocks, and there's dividend indexes out there, that basically do all the hard work for you, or you can just look historically at some of the best dividend stocks and just own some of them. Now, they're not going to be exciting. They're probably not going to appreciate in value a bunch. You're not going to look at it and be like, oh, my dividend stock's up 20%. That's amazing. It's probably not going to happen, because it's not going to be appreciating, because what they're doing is just consistently paying dividends, and that's the most important thing. So that's another good one. So we have cash, we have gold, we have dividend stocks, we have real estate or things, investments that pay you money. People that are into crypto, maybe you want to just put a bunch of money in stable coins and, basically just get paid for someone to borrow them. Now you have to look at your own risk portfolio, etc. I personally don't trust a lot of these new platforms, or don't choose to invest in them. As far as stable coins, I think that's probably your best bet if you're going to get paid to basically like loan out your stable coins through one of these platforms. As long as you understand the risk, as long as you trust the credibility, of whatever platform you're using, by all means, that's up to you. Obviously, let's be real. The less history something has and the higher amount it's paying you, the more risky it is, or it wouldn't be paying you that much. So if you're making 20% to stake some crypto or on some crypto platform to loan them your stable coins, it's because it's a very, very risky investment. That's why it's paying you 20%. If you have something like a crypto platform that's 3 years old and you trust them, it's very, I don't want to say you can't trust it, but it's much more risky than, say, a stock that has paid a dividend for like 50 years straight and never missed a dividend payment, or even 20 years straight, or even 10 years straight. So history takes away some of the risk or the danger or the volatility. The longer something has a historical track record that it hasn't defaulted, it hasn't missed a payment, it hasn't effed up, it hasn't gone, head over feet, the less risk is. So probably the less it's going to pay you. So you're not going to find some dividend stock that is safe that pays you 20%. You're not going to find some crypto exchange. It's not going to pay you 20%, but it might be safe. You're not going to find a crypto exchange that's safe that pays you 20%. So there's a certain risk or a certain reward that you're sacrificing, and you have to figure out what your median is. What's the most important to you? Are you willing to take a little more risk? If you lose all this money, does it matter? Of course it sucks, but could you come back from it? Sure. If you're old and retired and you can't afford to lose that money, you don't want to take the extra risk, so you're willing to give up some of the gains. So again, in the end, diversification is probably key here. So things that pay you, crucial. I mean, very much underrated. And then obviously, XLRE, real estate. If you can't buy a house, you can't invest in a house. You don't want to have to worry about the upkeep. You can just invest in something like this, and they invest for you. And you basically, it's like fractional ownership, quote unquote, of a house. Essentially, is what the way to think about it. And they have stuff like that as well. Timeshare type stuff, but without the scamminess. So then XLU on top of that, utilities, something that people are always going to need. The same way they need a place to live, they're going to need all their utilities. And then finally, XLP, consumer staples. People need that stuff. It's not going anywhere. So that's my basically like safety sort of portfolio. But in the end, it's key to have diversification, whether it's cash, whether it's gold, whether it's crypto, whether it's stocks, whether it's, geographical diversification, whether it's physical versus a digital asset. In the end, diversification is key to me, because if one of these things blows up, if we really go into uncertain times and one of these things randomly goes to zero out of nowhere, you're going to be much more protected if you're diversified in different sectors, different fields, different assets, physical versus digital, different countries, different whatever, because who knows? I mean, worst case scenario, you have everything in the United States, in the stock market, in the dollar, in whatever, all property, you're just all in on United States because you're just super bullish on USA. And then all of a sudden, God forbid, World War III happens and, somebody drops a nuke on USA. Well, it's not going to look diversified if you had everything in USA assets. So it's good to have geographical diversification. Same way that you get some crazy situation where the internet goes down or there's an EMP or whatever. Sure. I know the Bitcoin network will still happen through satellites, and there'll be people that have generators that are still mining Bitcoin. And I get it. Okay. The blockchain continues on, but the trust in that blockchain or safety or the feeling or the amount of people that will be invested in these digital assets will change. The same way that if the stock market randomly is just shut down, something crazy happens, and they've done it historically before. It's happening right now in Russia, but they've done it in the United States before. They've done it in many countries before, where they just halt trading and the stock market is done. It closed down for like a year before during the war. So if something like that happens and you're just trapped or whatever, or the value, starts capitulating and then they just halt trading and you can't get to it, you're going to wish that you were diversified into physical gold or maybe into crypto. So it's key to protect yourself in all these different ways, and to diversify. Now, your age, your risk tolerance, your whatever has to do with how much you're going to diversify. So it's not just about conviction. You're not just like, oh, I love crypto, so I'm all in and I'm young, so who cares about diversification? Sure. Okay. But then also when you lose everything, which probably won't be that much if you're young and you're making dumb decisions like that, it probably won't matter as much. But if you're old and you don't have 30 years or 50 years or whatever, where you're going to be able to make back your fortune, or you have a lot more money and it's much more important to protect, you need to be protecting yourself with diversification and not trying to just bet on like AMC or GameStop or whatever. But you already know that because you're old, so you're also wise. So next that's our little talk about diversification and how to protect yourself in a recession and, how to position yourself. Obviously, none of this is financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. Next, we have VWO, Vanguard. So we saw basically all these foreign stocks that have just been getting their absolute dicks kicked in, had a nice little bounce. So we saw VWO, the Vanguard Emerging Market ETF, came back up and retested that level. So we broke down from our blue ascending support line, shot back up, retested it. This is crucial now. This thing was headed straight down. We can see by the moving average, it's going straight down. So we knew it had to bounce at some point in time. But now the question is, when it bounces back up and hits right here, does it get rejected and go lower? Or does it come back up and start to reclaim this area, start to chop back around, put in a higher low, and then start going up? I suspect it will probably chop around and then get rejected and go lower. But if I'm wrong, we know what it's going to look like. It's going to chop around for a little bit. The moving average is going to catch up. The 8's going to cross back above the 21. It's going to start reclaiming levels. It's going to start putting in higher lows. Then we're going to get a move back up to like 50, retest 200 exponential and simple. Then we get a breakout of the top. And then at that point in time, we're already, fully positioned back in this, if that's where we want to be. So next is the DAX, obviously Germany. So, bouncing that support like we talked about. We're basically discussing about how we've broken down from this a bunch of times and recovered it many times. The difference is if we get this massive like capitulation dump, or if we just get, where we break down from it short term and then get a push back up. So far we have a push back up. We haven't lost. I mean, the 200 exponential and simple are technically in a bear market right now. But is this just our, retest? Is this just the reversion to the mean? We get a push back up here to like 29 and then we go lower. Do we just consolidate at this range a little bit and decide? Or, do we just shoot back up to new highs? Well, we don't know, but we know what has to happen for each of those things. So that's what we're paying attention to. In my opinion, nothing has changed for me in the last couple of days. You can tell me, oh, well, crypto and the new executive orders. You can say, oh, well, looks like Ukraine's talking and maybe they're going to sign a peace treaty. Oh, Venezuela is going to pump extra oil, or the Saudis are going to pump extra oil, or, what, any of these things. None of these things have changed for me. And when people say, well, it's already priced in, it's not priced in, this is different, it's different this time, is it? No one really knows. I mean, some stuff's priced in, some stuff's not, but there's so many things that are priced in, and so many of them are going to be right, so many of them are going to be wrong. Like people are saying the CPI is going to be through the roof tomorrow. I think it's tomorrow, right? Yeah. So it's going to be like, what if it comes in at 8% tomorrow? And then somebody else was saying, well, it's already priced in. And it's like, well, it's priced in. It's probably going to be around 7%. If it comes in and it's really bad, over 8, it's probably going to be bad for the markets. If it comes in and it shows up at 6 and 7 was priced in, it's probably going to be good for the markets. So it's not what was priced in. It's not the number. It's the number in relation to what people are expecting. And the truth is, all we can go by is what people come out and say they're expecting, what the estimate is, and then just the relationship to that estimate. So if it was just normal times and all of a sudden we got a CPI print of 7%, it would crash the markets because it would look horrible. But right now, when everybody's used to 7%, if it comes in and it's like, 7%, no one's going to care because we already know it's 7%. So it's all relative to what's going on at the time and what people are expecting. So China is next. China broke down from that key support. This is the CN50 USD. Obviously broke down from that key support here in white that was holding it up this whole time. And then it had a pretty aggressive wick down here all the way to 13,000. And then actually came back up to 13,654. So it got bought up pretty aggressively. Looks like it wants to come back up and retest, what was support as resistance. But again, I think it pushes back up and then gets rejected and goes lower. This to me just looks like, once again, a dead cat bounce. Now, this is a bottoming candle. This is a nail, obviously, a hammer. It looks like a nail, literally. So typically what happens with this is we go lower, the market rejects lower prices. So we get a huge wick right here, hammers the price back up, and then we see continuation back to the upside. But you almost always get one more push down to see, is this going to hold? And then we really see what's going to happen. The same way that when we see a topping candle like this, shooting star, it basically has that huge tail on it, like a shooting star does, like a comet does, and then a tiny little body. And all it is we're trying to go higher. The market rejects higher prices. And then after that, we see continuation. Usually, though, they're more forgiving to the downside than they are to the upside. Usually, when you're going to upside and then you get rejected, you see continuation of downside afterwards. You don't get a second chance out of your position. Because, keep in mind, especially at all-time highs, here we're at least retesting a support where we've previously been before resistance. To the downside, oftentimes what will happen is we'll find a support and then we'll put in a higher low and then we'll continue back to the upside. Now, it's not a fact. It doesn't have to happen that way. But, that's typically more market behavior, in my opinion, is that we would get a second test. Now, a lot of times you'll have a wick like this. We'll come back down, fill the wick, and then we'll go higher. Or we'll come back up, fill those orders right here or exit the positions and then go lower. So, anything could happen. But typically when you see a candle like that, it's potential for a reversal. After we see a reversal candle, then we want to see a candlestick pattern or reversal pattern or structure. After that, we want to see reclaiming lagging stuff like moving averages or, building of momentum from MACD or stochastics, RSI, whatever you're using. But typically the candle is our first indicator. We're looking for support, so we're looking for an area to already pay attention to. That's our first sign, is a key level already identified in advance. Second is a rejection candle of higher or lower prices. And then that's like confirmation from the market that we're potentially reaching a top or a bottom. And then the third is a candlestick pattern, which is telling us multiple candlesticks in a row that often represent the psychology of the market that would lead to either a high or a low. And then after that, we start to see all the lagging stuff start to show up, which is like our MACD, which is our stochastics, etc. So same with moving averages, obviously. So, there's big importance placed on anything that is predictive in nature versus anything that is lagging in nature. Moving averages are the most consistent as long as you're trending, but they're also the slowest because they're lagging. The same way that like your RSI or your stochastics or your MACD are all lagging. But things that are, support, resistance, things that you can identify in advance, those are the best, because once you reach them, you don't know for sure it's going to be the area, but it's an area of interest that the market would be interested in. And then when you start to see the psychology inside of a single candle print or on a shorter time frame, that can then lead into, your bottoming and your topping. So next we had the UK 100. So obviously saw a very aggressive move here. We hit our target perfectly. We were looking at the bottom right here to the top right here. And then obviously we talked about the 236, the initial basically like capitulation through that, and then a potential retest. We came all the way, we tagged the 382 exactly perfectly right here. And then we saw a bounce back up all the way to the 236 initially, and then a temporary rejection. And then we saw another push back up here all the way to the 200 exponential and simple. So again, what I would expect now though is the same way that people were buying the dip every time on the 200 exponential and simple, and then eventually we lose it. I would expect the same thing to happen, where this is now a reversion to the mean, and then people would be exiting their positions where they previously bought to just go neutral and see what this, see what happens. So people taking profits right here, people exiting, losing positions right here, but now we're back at fairly priced. So when we're above the 200 exponential or simple, we're overpriced in comparison to the last 200 candles, but we have the trend in our favor. When we're underneath it, we're underpriced. It's on sale compared to the last 200 candles, but there's people upside down in the position and the momentum is starting to switch. So now that we're evenly priced again, there's no advantage to the upside or the downside, because if you look at the last 200 candles based on, no weighting, or with the exponential based on the weighting of, recency over, the oldest candles, we're basically neutral now. So you're not getting a good deal. You're not buying it at a discount. You're not overpaying for it, but now the trend is no longer to the upside. So when the trend is to the upside and you're getting it at fair value, that's why you're buying the dip every time. That's the psychology behind buying the 200 exponential and simple. Once you break down below it and they start to flip bearish like this, you start to enter into a bear trend. Now you're selling fair value. You don't want to sell down here because you're selling far away from the moving average. So you're selling at a discount compared to fair value. Once you push back up after that break, now you're selling back at a fair value. So a lot of people will be exiting their positions and then waiting to see what happens. If we reclaim these levels, things start looking good again, people will buy and then it will continue to the upside. If, things start looking worse, or the fundamentals start looking bad, or we start hearing more about Brexit, or, energy price spikes, or all of a sudden we get another cold front comes in, or whatever the situation is, that leads to this, then maybe we see that continuation, or just in general, the economy slows, whatever it is, then we would see continuation. But the fact of the matter is right now, this is the de-risk area because it's fair value. So that is it for our indexes. We got some foreigns in there. We got some traditionals in there. Let's go to, let me jump in the comments here real quick. What's going on, everybody? If you are there, if you're listening, we're about an hour and 18 minutes in. If you're enjoying the stream, make sure to leave a comment, like, subscribe, all that good stuff. CW says Obama 2.0, the white years. You mean because Biden has white hair? That's what you're talking about, right? CW, smashing the likey like. Yeah, for sure. Smash that likey like, my friends. Smash the likey to the up-hand side. CW says, do you ever trade inverse ETFs like SEF or SQQQQQQQQ? Yeah, oh yeah, for sure. The best inverse ETF probably ever created is, what? Say it with me now. SARK, right? SARKKKKKKK. that short ARK fund. Yeah, I mean, yeah, definitely. I mean, there's so many ways you can play the markets, man. With the inverse ETFs, with the with options, you can play it however you want. It's really just about what you like as a person. A lot of people like options because, it's basically all or none. You're either right and you make a bunch of money with a bunch of leverage, or you're wrong, the option is worthless and goes to zero. Or, you're right and you get paid for selling the option and, it expires worthless, or you get paid and then maybe miss out on some upside potential. So it's just how you want to do it. Shorting markets, in my opinion, not my favorite thing to do just in general, because my main goal and main success has been through finding, basically things that are going to go parabolic. Like we talked about, I think last stream or a couple streams ago, where, if something goes to zero, it can only go down 100%. It goes from its current price to zero, you lose 100%. But if something goes to upside, if it's $10 stock and then it goes to $20, you're up 100%. If it goes to $50, you're up 500%. So you're never going to find that same risk reward to the downside. It can only ever go down 100%. And at prices that we're at now, not as much with the indices, but like on a lot of like various tech stocks or whatever, there's like the risk reward to the upside versus the downside is like just ridiculous. I mean, for something that was like something like Zoom, whether you believe in Zoom or not, whether you think they have some proprietary thing or just anybody can make their own like Zoom and Zoom is just garbage, it went down from $600, which was obviously overpriced, down to $100. We don't know if $100 is still overpriced or if the market is overreacting. But what we do know is that if it returns back to its previous all-time high, it's up 600%, or back to $600 from 100. But if it goes down, it can only lose 100. So if your upside is another $500, but your downside is $99 or $100, well, am I going to take that downside bet? I don't like doing that because there's just, in my opinion, there's so much risk compared to the reward of shorting it. But you like for shorter term scalps or whatever, or as long as you have your stop loss in place or options plays, whatever, you're probably fine. But again, also another reason that I don't like shorting indexes as much, or like ETFs, like reverse ETFs or whatever, is typically there's something in particular, like sector wise, it's easy to say like, okay, this sector is probably going to suffer and it's probably going to go down some. But look what would happen if you would have shorted like the Nasdaq versus if you would have shorted like Zoom, or you would have shorted the Nasdaq versus shorting like, some other tech stock that's just absolutely wrecked right now. You'd be, if you shorted the Nasdaq, you're up like 20% right now. If you shorted Zoom, you're up 80%. So you're almost always, in my opinion, better off trying to pick losers than trying to pick winners, if that makes sense. So the index is better to the upside often, but picking a loser or something that's suffering or not going to do well or has terrible management or whatever, to me is a lot easier than it is to make that same money on an index. I hope that makes sense, how I'm kind of getting at that. But yeah, I just think the upside and downside potential of an individual stock, it's easier to pick a loser than it is to pick a winner. And if you're picking a winner, it's probably because they're already winning. If you're picking a loser, it's because you see something that's other people aren't seeing. So you're kind of like arbing like the mistake or the inefficiency in the market. As where like if you're shorting an index or longing an index, I would rather be long an index because you're almost always going to have, like, for instance, like the S&P it's full of strong things because that's how it's, rebalanced or like reconfigured. The Nasdaq's always going to have like the Apples. It's always going to have the Microsofts, the Teslas. It's going to have, the winners, basically, the NVIDIAs. So when you short something like the Qs, for instance, sure, it can go down. The whole sector can go down, but you're shorting the strongest stocks in that sector in addition to the weakest stocks. You're almost, in my opinion, just better off shorting the weak ones and buying the strong ones than you are trying to fight against the strong ones while the weak ones are getting crushed. So I hopefully that made sense. Honkiness, what's up, brother? Good to see you, man. On oil, looks like it's retesting a major horizontal resistance. Very bullish if it confirms retest, right? Yeah, I mean, it's basically it was a resistance. If it acts as support and holds, it probably sees continuation to the upside. Now, when you say very bullish if it confirms the retest, I mean, I would say that it's already very bullish, and that retesting and holding just means continuation. I don't think oil could be more bullish than it already is. That makes sense. I mean, I've been bullish on oil for, at this point in time, what, like a couple years it's been. So I don't think I could scream any louder at the top of my lungs how bullish I've been on oil. I mean, I've made fun of Kathy Wood's $12 oil target for like 2 years now. I did an entire video about when she called the bottom and her top on oil and her tweets and everything, and how, you know, we've been long on it since. Energy, you know, oil, you know, uranium, all the energy sector in general, not the clean, green, you know, bullshit hippie energy. I'm talking about real energy that works. So I can't be more bullish on oil, man, to tell you the truth. For me, I like to buy things when they're cheap. I like to sell them when they're expensive. So for me, is oil expensive right now? Well, I mean, it's only been more expensive like for like 2 months in all of existence in history. So when adjusted for inflation, maybe you're like, well, it's not that expensive when you adjust it for inflation. Well, sure, totally agree. But if you adjust it every other year from the peak in 2014 to now, every other year also adjusted for inflation, there was times when it was expensive and cheap, and now it's literally at like the all-time high, basically. So for me, it's very hard to be any more bullish on oil, especially after the run it's had. If anything, I'll be more bullish at oil once it has a respectable pullback to a key level. Then I'll be more bullish on it again. But I don't really see any value in oil now because the risk to the downside is much higher than the risk to the upside, in my opinion. Now, once we break through the all-time high, consolidate for a little bit, have a decent little pullback, and then we start moving back to the upside after a bullish reset, then I can be very bullish on oil again. But just some little arbitrary like Fibonacci, you know, when we've already just went on a parabolic run, it's very difficult for me to say that I'm going to get more bullish on it just because it's already had a huge run. So for me right now, oil, still have part of my positions open, obviously, still bullish on it until there's reason not to be. But in no way am I like buying the dip right now on oil after a couple percent pullback, after like the most epic run it's like almost ever been on. So that's kind of my breakdown for it. So let's keep ripping. So what do we want to do next? Let's jump over and do all right, we'll do commodities next. We'll rip through them real quick. So gold obviously ripped all the way back up to retest the all-time high. Now, depending how you look at this, you know, technically the wick is a little bit higher right here. But as far as I'm concerned right now, it's a double top. We know historically also, you know, and this is what we were talking about too. We're a couple percent away from the all-time high. So we said, let's wait until we break out to new all-time high, confirm, consolidate, retest, and then buy in on a retest, on a pullback, whatever, not get caught in a rejection like this. Similar to what I was talking about with oil. We don't want to get caught buying the all-time high and it ends up with a double top scenario like this. Now, gold and silver are known historically and continually for having cup and handle patterns take place. Silver's cup and handle pattern is like 40 years like building. Gold just had one recently, and it looks like this could potentially be another one. So what we'll be looking for with gold is this a double top? And then we enter into basically a channel, a descending channel, and then eventually a breakout of that channel, and then we start to form the handle, and then that's when this is going to look really bullish. Or we break out, come back down, retest, consolidate at all-time highs, and then it'll look really bullish. But right now, for me, you know, this to me looks like a at least temporary double top. We'll see what happens after this. If we come back down to this level at like 1900 and that starts to hold and we build support there or whatever, and the moving averages keep strengthening, then again, I'll be more bullish on gold. But I feel like I'll be buying at a value area after a push up, consolidation, and then potential breakout, and that would lead to like that cup and handle pattern. But again, I'm already positioned in a lot of these things too. So if you were thinking about buying gold at 2000, you don't have any gold, and you have a strong fundamental and technical reason, and you want to diversify your portfolio, after it runs up to a new all-time high and gets rejected, it's a better time to buy at 1970 than it was at 2060 to buy the breakout on FOMO. So that's where you have to kind of think about it. See, part of the problem is, and again, obviously it's not financial advice, but I'm already positioned in a lot of these things. So for me, I'm not rushing to buy gold when I was buying it at 1,300 and now it's at 2,100. If anything, I'm wanting to take some off the table. Now I don't sell gold and silver. If I do, I'm trading paper contracts just as like, to balance or something like that, or like an ETF or miners or something like that. But I would look for this to come back down to key levels and then continuation to the upside. I don't think gold is just like going to die or anything like that now. I also don't think it's just going to immediately break out. I think this was a pretty aggressive move to the upside. And now we'll look and see, where does this consolidate? Where does it pull back to? And then we can get a better idea what we can expect in the future. But right now, what I expect, just based on history, what I would expect gold to do is, I have a feeling gold is just going to make a cup and handle. So typically what will happen is it will run back up to the previous all-time high. It will top out. It will have a 50% retrace or back to like key support, which if we just do a quick Fibonacci from the bottom right here to the top right here, or I guess realistically we already have one in place from the top here to the bottom here. But essentially that's just the same. It's just the inverse version of our orange fib right here. But the 50% pullback would be basically back to this peak right here, or the 618, which would be the opposite, because obviously we have an internal retracement fib. It would be the 618 would be the 382. So I would look for basically a place to load up around 1900 or 1866. And what would make me think that situation, that we're talking about, the cup and handle, is or will be playing out is, I would look for a situation like this. This is what we see happen in a cup and handle. We see a big rounding pattern, a double top, and then we see a consolidation in a descending channel, and then the breakout of the channel, which would also be potentially, depending when we hit it, a retest of this resistance. That will typically be the beginning of the handle forming, and then when we get to the 50% mark, somewhere around here, then we get the breakout back to the upside, and then what you see is the measured move of the actual channel breaking out to the upside, and then that breakout will basically take us back to all-time highs, and then we break out, and then we hit the measure move of the entire pattern, which is going to be obviously from the bottom here to the top of the cup right here, or the brim, and then all the way back to the upside would take us obviously much higher. So that's what I'm looking for. Obviously gold was it's very bullish recently, had a very powerful move based on fear of World War III or commodity surging or whatever. I suspect it will probably, obviously we were expecting kind of a double top cooling off right here, but I would look for this to play out as we just discussed. So silver, obviously again, much less bullish than gold, just complete underperformer once again. Push back up, couldn't even get close to the $30 top right here. Silver is just, it's a dog. It only is going to outperform gold later in the cycle. So you always have plenty of time to position yourself in silver. And by the time everybody's excited about silver, the move's probably over, in my experience. So gold silver ratio, obviously still just consolidating around that level. We'll see what happens here. It looks like it's losing some steam and starting to roll over a little bit. COPEX, so copper kind of broke out of the pattern here. It is putting in a slightly lower high right here. Now keep in mind this is a minor ETF, but again, it's been in this ascending channel. Sort of had this little burst out of the top and then failed to hold it as support. So it looks like it's going to come back down and start testing some of these key levels. Looks like commodities are going to have a little bit of a relaxation fest going on here. Silver juniors finally broke above 200 exponential and simple, came up, hit a key level, got rejected pretty heavy. Trying to move back up here again, but again, I don't expect the miners to do particularly well if the underlying is not doing well. So GDXJ, nice little move up here. We'll wait and see what happens when it comes back down, when it finds support. Where does it find support? If it retests the 200 exponential and simple, holds as support, I would expect this measure move to continue playing out. Same way I would expect gold to be bullish, if it starts holding key support levels. But right now, looks like commodities are at least seeing a temporary top. Does not mean I'm not long-term still very much bullish on them. Going into the future, do you expect there to be more food or less food? Do you expect there to be more gold or less gold? More silver or less silver? More, copper or less copper? More gas or less gas? Do you expect demand to be higher or lower? take into account those things, build a fundamental case, look at the technicals, and then make your own decision. So now here is one more thing that I wanted to talk about as far as positioning for a recession. There's another thing that people often forget that does well in recessions. And obviously, pot stocks just getting absolutely crushed, continuing to get crushed, the worst performing, asset class in existence for like the last 3 years straight, pretty much that I can even think of. So just getting absolutely destroyed, but at some key nice value levels, still just going lower, probably going to continue putting in all-time lows. You guys know that going into everything that happened, I was extremely bullish on energy. I was extremely bullish on commodities. We nailed the uranium trade. We nailed the oil trade. We nailed the crypto, move. We nailed the gold trade, the silver trade. We've been on top of everything. And you guys know miners this year was one thing I've been talking about. And the other thing was pot stocks. So here's the thing about pot stocks. One, they're at extreme, value levels, or as Kathy Wood likes to say, deep value territory. But two, if I'm right about the recession coming, or potential depression, or slowing of the economy, or stagflation, or stagnation, or whatever you want to call it, there's another thing that does extremely well. Things like alcohol, tobacco, pot stocks, or pot in general. Because the truth is, when times are shitty, people like to find things that they enjoy. Or, instead of going out to, a bar or a baseball game or a sporting event or whatever it is, maybe they stay at home and they smoke a couple extra cigarettes and drink a couple extra beers, or, smoke a joint or whatever it is. So in general, when things are not going good economically, people will tend to turn to their vices. So you'll see more people gambling because they're trying to beat the system and get out of their shitty situation. Or you will see more people seeking, alcohol or marijuana or whatever it is, because they're trying to just drown their pain or their sorrows, or, get through tough times. And it's unfortunate. And I would in no way encourage people to take advantage of that. But the fact of the matter is, historically, tobacco, alcohol, gambling, and marijuana do well in recessions. So that's something I'm looking forward to. So I have a very strong case for, one, the asset to book value ratio of a lot of these pot stocks. Two, the fact that they've been getting absolutely crushed forever and that nobody wants anything to do with them. They're just absolutely hated. They're like the black sheep of the group. Or, I don't even know. Are we allowed to say black sheep anymore? What do we even say now? The ugly sheep of the group. I don't know what's politically correct, guys. I'm not good at that. Whatever you want to call it. The sheared sheep of the group. Okay, nobody wants anything to do with them. They're just terrible and they're ugly and everyone's just so upside down, or they've lost money and they just won't touch it. That's when things are most appealing to me, when no one wants anything to do with them. That's how you know the bottom is close to in or in. So that's two main reasons why I'm bullish long-term on pot stocks, or potentially by the end of 2022. And then the third one is, obviously, we have talked about it over and over and over again about this, two main reasons on top of those why I'm bullish on pot stocks. The first one is because governments, most of these stocks are Canadian, because obviously it's not federally legal in the United States, so they can't list American pot stocks on American exchanges until it's federally legal. And that's probably years away from now. But until this industry in general is legal, they won't have them listed. So naturally, I'm more bullish on Canadian stocks. But regardless of all these pot stocks all over, or this whole industry, the taxation is huge, because government's going to seek a way to kind of fill the gap between all this spending, this ridiculous spending, and all the stuff they've done, and ways to get extra money, other than just deficits. Because, yeah, they can keep deficit spending, they can keep wasting money, they can keep printing money, whatever your argument is, that's fine. But realistically, government try to figure out how they can get more money. They either want to raise taxes on existing products, or they want to tax things that they're not currently taxing. So crypto, legally, you have to pay taxes on it, but people aren't. So now they're going to raise enforcement to go after those people, to make the people that are supposed to be paying taxes pay taxes. We already know that. That's obvious. They've made it clear. They've already said. They ask you when you fill out your taxes, Did you trade, buy, sell cryptocurrency? That's because they're going to try to catch you for not filing your taxes, which you should. You should pay your taxes. Whether you agree with them or not, it is the law, and you don't want to be a criminal. Or maybe you do. I don't know. Maybe you're a pirate. Pot stocks, however, or pot in general, they're not able to tax right now because it's not legal. So if they can legalize this and then let this industry, we saw it happen in Colorado. I don't know the numbers off the top of my head, but if you look at since it was legalized in Colorado like 10 years ago or whatever, one state to now, I mean, the revenue that they have generated through taxing it and like the, selling people licenses, people licensing or renting like actual stores, people buying warehouses and growing it, people buying all the equipment, them taxing the sale of it, them taxing the businesses for the income, them taxing, the employees of those businesses. The amount of money that they have made off of that industry is massive. So when you figure there's how many states it's not even legal in, let alone on the federal level also, they get to dip their hand in the honey pot or the cookie jar or whatever. In my opinion, they're going to move forward with this because it's massive amount of revenue. So now we have a bunch of strong cases. And then the final case is, they've been polling obviously Americans, and you can't always trust the polls and they're not always right or whatever. But it's something ridiculous now. Like 90% of Americans polled don't care about pot stocks or pot rather, or just say make it legal. Even a lot of people who don't care to ever smoke pot either don't care about it or know a bunch of people who do. So they say, whatever, legalize it. It's no worse than alcohol, so I'm with it. Or maybe they have, a kid that has seizures or a dog, or they know someone, that has a medical condition that has been helped through not pot itself, not THC, but CBD. So therefore, there's a lot of people that even have no interest in drugs or alcohol or anything like that see the medicinal positives or purposes. Maybe they know someone that was addicted to, a painkiller or a prescription or something like that then was able to get off of that heavily addicted hard narcotic through something like, marijuana or CBD, or got off of hardcore painkillers for CBD, or, whatever the situation is. People have warmed up a lot towards it. So I think as we come up towards midterms, I think it's going to become a huge talking point, and all of a sudden people are going to look at it and they're going to say, oh, wait a minute. Everything else is getting crushed now. Pot stocks haven't really done anything. They're like super deep and super sold off. Now might be opportunity to buy something that actually like makes money, that it has a company that, well, I mean, some of them are not profitable, obviously, but, is essentially at a good place valuation wise and has been rejected or, shunned for years. And now all of a sudden it's, coming back in the limelight and could see a potential 20%, 50%, 100%, 1000% gains over the next couple of years. Now, does that mean I think that pot stocks are going to be legal federally in the next couple of years? No, I don't. I think it's going to take forever. Government takes forever to do anything. But it doesn't mean the sector is not going to do well. So that's my argument behind the chronic. And then last one for the commodities, Cameco, just as a proxy for uranium, obviously, it helps that we didn't see a complete meltdown or whatever. So that's definitely good. Like the Fukushima scare or whatever, uranium popping back up, kind of doing like the opposite of what oil is doing right now. Sort of like the struggle between, now it's like all of a sudden, oh, we need independence from oil so we can get away from all these foreign powers. And then it's like, well, maybe we should use this nuclear thing. It's not so bad, right? So, we're going to probably see a bunch of push-pull taking place with these things. And again, it's the same situation. To me, they're not great value levels right now because they've already come so far. But again, if I didn't have a position in gold or a position in energy, uranium, oil, whatever, maybe I would build a small position or start buying into momentum to the upside. So that's it for our commodities today. Let's go to, let's do cryptos. Do some cryptos. So Bitcoin futures chart, obviously we had a nice little pop up right here. People are like, oh, it's because, Janet Yellen released a thing and they said now they're going to like look into crypto, and then they're going to form a committee, and then they're going to look for regulations, and now it's bullish because we're one step closer to the ETF. And I don't know if anybody has ever like seen the government or what happens, but they never do anything. Nothing ever happens. So if you're like, we're one step closer to the ETF, sure, we're on step 9 out of 100. So we were on step 8, now we're on step 9. They're going to form a committee. The committee is going to come back in 6 months. They're going to say that they need more money or more information, or they still don't understand it. And then 6 months from then, they're going to do something else. And then, I mean, I don't see anything changing. So people are like, oh, this is the pop. This is it. We're going. This is the big one. You know, we were talking about it in the group, and it's like, you know what? Sure, it probably was a 10% move. But I'll tell you the truth right now. You know, what was this pop? What was that pop? It's the same exact thing. Look, we had a rejection candle. We rejected lower prices, had an aggressive wick, kind of chopped around for a little bit. Then we had a big pop. Okay. Then we sold back off. We had a rejection of lower prices at a key level, you know, and then chopped around for a little bit. And then another pop back to the upside. And then we came back down here, rejected lower prices, and then we had another pop to the upside. Well, what happened every single time? We reclaimed the 821 here, crossing back to the upside, and then failed. We reclaimed the 821 here, crossing back to the upside, and then it failed. We reclaimed the 821 here, potentially finding support now. Maybe they cross back to the upside. We get another pushback up, and then what? Probably fails again. I mean, we're just range bound. We're dropping around. And this is a bearish pattern. I mean, we have a, you know, basically a flagpole down, and now we're basically in a tightening range. And then typically what happens is we see continuation. And the most important thing is the first pushback up here that we saw, we came exactly up to the 200 exponential. We got rejected, couldn't get to 200 simple, came down lower, put in a higher low, came all the way back up, tagged the 200 exponential again. Then we pushed higher. The second time when we pushed higher, we failed this time. Here when we pushed higher, we hit the 200 simple. And then we came back down, and once again, we have a low, we have a higher low right here, and then slightly lower low right here on futures. On spot, it's not actually lower, but now we're pushing back up. So what happens? We probably, if we make it back up there again, we probably just get rejected at the same spot again. Depending how you want to draw this, what exchange you're looking at, or if you're looking at, you know, futures or spot market, I would be looking at it as something like this. And this is, you know, you can draw it on shorter time frame, you draw it on longer time frame, you can use the wicks, you can use the bodies, you can use whatever you want. It all looks different somewhere else, but the mentality, the psychology behind it is the same. We're in a tightening range right now, basically. We're chopping around, and we're under resistance. So as long as we're under the resistance, which in this case is our key Fibonacci level at like 43K, and our 200 exponential and simple moving averages, as long as we're under them, you know, this is bearish to me. We're in a bear market. We're below resistance. So it looks like we're going to break down. Now, if we break up from here and we reclaim 45,800 and we start to move back around here, I could start get bullish on this again because we're back above resistance. We see the 821 cross back to the upside. We see the 200 exponential and simple flip back over blue. We start to move back up, you know, come back up here to like 54K. Then we start, you know, getting a little cautious because that's our target back to the upside. Does it have to make it up there? Could we get rejected here and just go lower? 100%. So, but we already have this potential situation where we're looking at 54K as our next target to the upside. But we know that regardless of if this is the top or 54K is the top, that my overall, you know, prediction or target is to the downside. So I still think we have a lot more pain on crypto for now. And I don't see anything that tells me we don't. Short term, though, we may have a nice bounce. We'll see. Here's our spot market chart on Bitstamp. I think I already have it drawn in on this one. So this is what we were talking about the other day. Depending on how we draw it, this was the bottom of our triangle. You remember we had drawn in the green support line here. We drew in the blue support line here. We came down to the support. We held the support. It was the exact point where both those intersected, the green line and the blue line of the triangle. Found support. And then we got the pushback to the upside. So you're like, oh, it's because Janet Yellen's statement. Oh, it's because of the news. It's because crypto's bullish. It's because we're going to get the ETF. It's because whatever it's because, we already knew it was going to happen because it was the bottom of the triangle. So the technicals always win. They always win, in my opinion. You know, maybe you don't believe in them. It's funny when people are like, oh, yeah, it's the technicals. It hit support. It's the voodoo magic. Sure, okay. The same people will be like, guys, did you see the news article that just came out? And Janet Yellen accidentally posted up a thing that says they're going to do nothing and this is bullish for crypto. It's like the same thing. You know what I mean? Like the people who trade news think technical analysis is like mumbo jumbo. The people that trade technical analysis think like news is mumbo jumbo. Whatever works for you is all that matters. If you can consistently show me a way that you make money trading the news, by all means, I believe you. If you're like, I look at the sentiment chart and it never lets me down, or I'm just the first person who sees a news article and I position myself before the masses. whatever works for you, that's fine. I have no problem with people making money as long as you can, replicate it and write down on a piece of paper how you're doing it. If you just say like, oh, I just read the news articles on CoinDesk every day, and if I think it's a good article, I buy. If I think it's a bad article, I sell. That's probably not going to work out over the long run. Might work out a couple times, might work out a bunch of times even in a bull market, but might not work out the way you think it is. So in my opinion, we're just chopping around inside this range right now. And as far as I'm concerned, until we break this range, we buy support, we sell resistance. So that's what I'm looking at. Still looks the same. Nothing has changed right here. I don't expect anything to change until we finally get a break. Very much still in a bear market. Ethereum, again, same thing. Did put in a lower low right here. It looks slightly worse in my opinion. I mean, it looks terrible. Ethereum still looks like terrible. So yeah, looks terrible. We're still just chopping around between the yellow and the orange. Didn't even cross the 821 back to the upside. Hard sell signal on the daily. I mean, we held above. We still have momentum on the TJD TDMACD for now, which is good. There's a little bit of bullish divergence between this low and this low, which is good, but nothing to hang your hat on. So we're seeing our Bitcoin dominance chart doing exactly what we expected. We have officially confirmed the weekly 821 across the upside. We have blue on the TJD TDMACD, and obviously powerful stochastics to the upside and a hard buy signal. So it's doing the exact same thing. I mean, this thing has been acting like our bitch for literally months now, and it's continuing to do so. So as far as I'm concerned, Bitcoin dominance is getting dominated by our technical analysis. I expect it to continue doing so. So next target is 45. I expect some chop around there, a retest of the cross, so maybe Bitcoin surges, maybe altcoins dump, and Bitcoin doesn't dump as bad. Either way, this pushes up a little higher. Then we see the opposite. Maybe Bitcoin starts losing market cap compared to altcoins. Altcoins surge. Bitcoin doesn't surge as high. And then eventually we break out of this range. When we break out of this range, it's either because Bitcoin's going absolutely nuts and the alts are just completely lagging behind, which I find very, very unlikely, because there's still a ton of people that don't want Bitcoin. It's too expensive, or they think it's old or dead or boomer coin or whatever it is. And they're just all about that Shiba Inu or that Matic or that XRP or whatever other trash bag coin that they're stuck in right now. So eventually when this breaks out to the upside, when Bitcoin surges, it's going to be probably because the market is going down, in my opinion. So when this breaks out, if we hit the measure move after this triple bullish divergence on the Bitcoin dominance chart, when this breaks out to the upside, I highly doubt it's because Bitcoin is surging up to 100,000. I think it's much, much more probable, with like 75% probability to 25% probability. If this breaks out to the upside and I'm right, I think there's a 75% chance it's because Bitcoin is selling off and altcoins are just completely melting down. And there's a 25% chance that I'm right about this breaking out to the upside, but it's because Bitcoin is surging to the upside and it's surging so fast that all the shitty altcoins can't keep up. Which, how many times have we ever seen that happen in history, where Bitcoin shot up to the upside and the altcoins just couldn't keep up? They just weren't gaining long enough with their tiny little market caps and their like made up white papers. It's like never happened. So maybe it's the one time it happens. We'll have to wait and see. But I have a feeling this is going to be a complete meltdown in crypto when this is taking place. But I could be wrong. 25% chance. I'm wrong. But I think there's a very high probability chance that regardless of whether it's a melt up or a melt down, that I'm actually right about this breaking out to the upside now that we have this 821 cross. Because the last time the 821 cross said downside was in February 2021. And the last time we saw this cross to the upside after a parabolic bull market, which is what we just saw, a parabolic bull market, obviously. When we saw that cross to the upside, that was in July of 2018. And what was July of 2018? It was the beginning of the nasty, nasty bear market of complete wreck city and trash bag altcoins. And just the initial move up was 40% increase in Bitcoin dominance. So again, I don't like to look at like fractals or whatever, but if we have something like that, like, just to retest the 200 exponential and simple is a 35% increase in Bitcoin dominance. And what is a retest of the 200 exponential and simple? It's just a reversion to the mean play. It's just going back from Bitcoin being, undervalued in relation to trash bag, altcoin, garbage coins, or fairly valued in relation to all of the, total cryptos, including itself and all the trash bag garbage altcoins. So I'd say, I'm probably going to be right on this one. Let's be real. Total market cap, essentially just getting crushed right now, continuing to just get crushed, finding a nice little support here at 1.66 trillion. It's at 1.72 trillion, 7 trillion right now, still below the 8 and 21. In order for me to even start to begin to get bullish on this, we have to close above the 8. So until we get a weekly close above what is now 1.8 trillion, which is just above our heads, until we get a weekly close above that, there's no reason for me to even start to get bullish on this. Once we do get a close above that, our next target will be a retest of the 21 at 1.95 or just 2 trillion. Once we close above 2 trillion, I will be bullish again. Once we get the 821 across back to the upside, I'll be much more bullish. And then at that point in time, I'll be bullish back on the trend again the same way. Ride it back to the upside. But does that happen anytime soon? Well, the market has to tell us. So we're just going to look at a couple random shitcoins. So Solana didn't quite get back down to our green area yet. We had that initial wick down, push up, rejection, couldn't cross the 821 back to the upside, just waiting. It looks like it's still going to have further downside. Now we do see, again, one drive down here, one drive here, and then a third drive here potentially with a low here, a lower low here, and a slightly lower low based on closes here. So we have 3 drives of bullish divergence on Solana. Just got a hard sell again on Solana, put in a low. So if this 821 crosses back to the upside, I will get bullish on Solana at about $90, $91 for a nice little 12% move, at least back to our Fibonacci, let alone back to the top of the channel. And then at that point in time, I'll start looking at the 200 exponential, 200 simple, the previous fib level at 141. This would be a nice, beautiful breakout to the upside if we broke out of this descending, broadening wedge or channel or however you want to draw it. But again, starting to look okay, but this is not going to do anything if Bitcoin's not doing anything, in my opinion. But there's definitely some potential there. Definitely some potential. 3 drives, bullish divergence. Got to be careful here with just 2 little green histograms, though. This could easily just roll back over and then put in a low and invalidate this bullish divergence. And this was our little bullish divergence push. And then we actually come down lower. And then we put in a true drive, a third drive, the bullish divergence. So don't want to get too excited on this just yet. Avalanche, full disclosure, obviously not financial advice. I did take a small position in Avalanche, almost got stopped out, literally within pennies of the close or whatever. But in all reality, I wouldn't have gotten stopped out. I would have taken my own stop loss and sold my position. But I do still have it open. I'm basically right back at break even right now. It doesn't look good. It probably is going to just completely melt down. I see Bitcoin is actually melting down as we speak. But I did take a small position on that because it looked like it was going to push back up here. But you could literally enter the same trade right now or exit this trade if you're already in it, and you'd be right back at the same entrance or exit point. It wouldn't matter. But the risk reward was decent, 6.6 to the downside and 28% to the upside. But the truth is, when we took it before, it looked slightly more bullish than it looks now because it was holding this ascending support, and now it has lost that ascending support and took out this. But arguably, if you were trying to make a bullish case on this and not be biased, you could look at it and say we have something like this, some kind of support holding for now. So maybe we just have a low, a higher low, a higher low, and then we eventually could push back up maybe to the 0.5 or something. Again, I'm not trying to convince anybody to take this trade. It probably fails. But I know if I flip this coin 6 times and I'm right once, I break even or end up positive. So I'll take that coin flip. If it was 2 to 1, I'd be much less likely to take it. And I could just as easily exit out of this at a loss tomorrow, and I wouldn't be mad about it. Matic. Again, we didn't really find any kind of useful trade setup on this. It's basically just at the top of the range. Getting rejected by the 821, 200 exponential and simple above its head. Hard sell signal. Doesn't look particularly great. Doesn't have that same bullish divergence that we saw on Solana. So the Solana trade, you can make a case on the, it's in the lower end of the range. It has momentum in its favor, and it has triple bullish divergence potentially. The avalanche trade, you could say, is potentially holding key support. It has, momentum in its favor. Doesn't have the same bullish divergence, but has a nice risk reward ratio to the top of the range where you would expect it to get rejected. With the Matic trade, there's just nothing here in my opinion. It's hard for me to find anything. We don't have the bullish divergence. We don't have an 821 cross. We don't have the momentum. We have the hard sell signal. We're at resistance. So there's no case for a bull case on this one for me. And the only reason I'm reiterating those is because we're seeing something on Solana that says, okay, I could see this being bullish. We're seeing something on Avalanche that's like, okay, I could see this being, a trade that's worth taking with some bullishness. But on Matic, we don't see anything. We don't see a favorable trade setup. We don't see any bullish signs, nothing. So Luna, I can't remember when we looked at this. I want to say, it would have been Sunday. So these are our candles since Sunday. So I think we were like right here on Sunday when we looked at it, and it looked like a lower high double top. So we came actually pushed back up here on this bullish Janet Yellen news, and obviously it looks like a double top. So if we consolidate here and start to put in new highs, it probably continues to put in new highs. If this starts to roll over right now, then we're going to have potentially printed, we basically now have, whether you look at this point right here or this point right here, if this starts to roll over and see red histograms, it's going to look like bearish divergence between these points, or it's going to be the same high on this as one point and a same high as this, but it's going to be a lower high on the histogram. So depending on how you look at it, the potential for bearish divergence is high. Now, if we invalidate that bearish divergence and we just continue higher, this probably goes, there's no resistance. There's no reason to sell it because no one is at a loss. Everyone now is basically break even or up on this right now. So if this just moves any more to the upside, it probably just keeps going to the upside. It's the most bullish crypto chart we're looking at. But also, it's the most risky because if you buy the top, the same way we were talking about gold, I would rather buy a bullish chart on a pullback than right now. But, you don't always know when it's going to happen. So if you had to buy a crypto right now and you were like, you have to buy one crypto, pick it, which one's it going to be? And I'm like, how long do I have to hold it for? And they're like, indefinitely. I'd be like, no, thank you. Just shoot me. But I'm just kidding. But if they were like, okay, you have to buy a crypto right now, what's the most likely one that's going to be going up from here? I would say probably Luna because it's already at all-time highs. There's almost no sellers above your head. There's only a couple of people that are even in a loss in this, assuming this is the full chart we're looking at. But I would rather have a favorable trade setup than buy a breakout. That's just me though. But there's definitely, there's a compelling case to say, well, look, there's not going to be any sellers because everybody's at profit and we're just going to go higher from here. I don't like buying breakouts. I don't like buying the tops. I like to buy support. So I would always rather buy support right here and be wrong and it goes lower than buy resistance and be wrong and then it goes lower. But that's just me. I'm the opposite. The people that want to buy a breakout, that's what I'm selling. So they're buying from me and I'm right more often than I'm wrong because I'm buying support, assuming it will go back up, and I'm selling resistance, assuming it will go back down. But that's just my style. So everybody has their own. The most important thing is know what works for you, test it, keep doing it, and then if it works, that's you. And there's nothing wrong with that. Nothing wrong with that at all. But I think probably of all the people I know that buy breakouts, most of them do not make money buying breakouts. I think more breakouts fail than succeed statistically. So obviously DXY was extremely strong. We're seeing some weakness now. Not a surprise at all. Put in a new cycle high. I told you guys I was expecting 100. We made it up to 99.241. And that was our target from a long time ago. I told you 99, call it 100. I'm good. So I do expect this to continue to the downside. This was obviously part of the fear trade. So still very, very bullish on this long term. Full on expect this to have a nice pullback, possibly as low as 97. Some of these other key levels on the way. Maybe we even get, I doubt we see a 200 exponential or simple retest. To tell you the truth, when we topped out right here with that bearish divergence, in my opinion, this was an opportunity for people to be exiting bearish dollar trades. And instead, people were saying, see, I'm finally right. Probably doubling down. And now they're getting wrecked. So I don't think the dollar is going to give people an opportunity to take advantage of it the way they just had to get out of a position. So Tesla, nice little pushback up to 200 exponential and simple underneath them, but it's basically neutral right now. Could go either way. I see this completely neutral. I mean, as far as I'm concerned, though, we're basically below support. Still operating inside of the same, descending channel pattern right here, right smack in the middle. So coin toss with the equal upside, equal downside. No, thank you. And I think they said for the first time, like ever, well, at least recently, Tesla has like more net shorts than longs, or more option puts than calls. And we know Tesla's only ever reached the levels it did because of ridiculous options trading and Elon Musk abusing social media and our stupid regulators. But hey, whatever. He's a genius. Dude's smart. Shooting rockets into space and taking dumps on regulators' faces. Ooh, could have made that rhyme. SMH looks weak. So broke down from key level. Our red support right here came down to our key fib level target, the 236. Push back up. This looks like we're hitting resistance now. I expect it to roll over, maybe go slightly higher, retest the bottom of the channel, retest 200 exponential and simple, but hit our target perfectly. So what is this? A reaction rally, a dead cat bounce, a reflex rally, other people just buying support, and I would expect them, if they're buying support, they're probably also the type of people that sell resistance. So they're probably people that think like me, act like me, trade like me. So for me, if I'm buying support right here, I'm selling resistance somewhere in where we're at now, here, or at the 200 exponential and simple. So buy support, sell resistance, seems pretty viable, and then we can start looking at lower targets at like 200 or whatever. But at this point in time, we have broken down from a key channel. And typically when we break out from a channel like this, and then we can't hold it as support, and then we break down, and then, break out the bottom of it, typically this was distribution taking place, a big fat dump all over some sucker, retail traders' faces. And then before the steam is even gone, it pushes back up, retest. They think, oh, we're buying support. It's going. Psych, they almost got me. Diamond hands. And then next thing you know, it gets rejected here, and then we go much lower. The opposite of what happened here, where you expect it to go much higher after the breakout. This is a fake out. This is the breakout, the real breakout. In my opinion, we'll see what happens. NVIDIA breaking down from key levels. Looks the same. Obviously the strongest in the sector. Netflix, had a little bounce back up here, basically still under resistance. I mean, Netflix looks terrible. It looks absolutely horrible. I mean, it's back on top of the 200 or the slope, but it's still red. I mean, it looks terrible. I mean, I wouldn't get mad at anybody for like bottom fishing something like Netflix at this level if you love it and you're just super excited about it. But at the same time, it's 358 right now. If I was going to buy Netflix and I was going to try to catch a knife on Netflix and say, this is it, I'm super bullish on Netflix, I would have a long time horizon into the future. I would be fully prepared for Netflix a month from now to be at $256. And I would fully accept that there's a possibility that going into the future, Netflix never sees all-time highs again. That's if I was going to go for Netflix, I would 100% say, is it possible we never see all-time highs again? And I would check that box. Is it possible a month from now, this thing loses another $100 in value and is down another 30%? I would check that box. And then I would say the final box on the paper is, do I still want to buy Netflix? And then if you can check that box, knowing those two things are legit possibilities, it's never at all-time highs again, and it might be down 33% from here. If you can check that third box, by all means. Not me. Not I. I just don't know if Netflix has a business plan that's sustainable going into the future. I'm not convinced that Netflix hasn't permanently peaked out, and I'm definitely not convinced that Netflix has bottomed out for even the short term. Apple's still strong in the same pattern, bouncing the 200 exponential and simple. I mean, still probably the best place to be. Microsoft, Apple. So Amazon ran up after hours, back up to almost 3,000, based on an announcement. What was the announcement? Well, something we already knew. Amazon is planning a 20-to-1 stock split. So does that change the value of the stock? No. Does it change the perceived value of the stock? Arguably, yes. The psychology behind that and you don't often hear people talk about it or why it is or isn't relevant now. So we'll talk about that for a second. Okay, if you're a retail trader and you're like, I want to invest in Amazon back in the day, let's say 10 years ago, and you're like, I want to buy Amazon, or back then it would have been Berkshire Hathaway, something that's just too expensive for a normal person to buy a whole share of. They were like, oh, shucks, I can't afford it. So you couldn't buy it. Then they came out with fractional shares. So you could be like, oh, I want to buy Berkshire Hathaway, but I don't have the money for it. And they're like, that's cool. We'll sell you 10% of a share. And you're like, oh, cool. I can buy 1/10 of a share. Awesome. And then you could still invest in it. So fractional shares made it so that if you were a retail investor and you're like, I have $1,000 to invest, but Amazon's $3,000. So it's like, cool, just buy 1/3 of a share. And you're like, oh, awesome. Now, of course, people rather have 1 share or 10 shares or 100 shares of something, just psychology wise, the same way they would rather have 1 shitcoin than 1/10 of a Bitcoin, because it just feels better if you have 1. It's easier to calculate the value of it if you have 1. Mentality, like psychology, tells you that you want full shares of something. You don't want a fractional share. You don't want a fractional crypto. You don't want a part of a coin. That's just psychology, but it makes no difference. So now that they have fractional shares, it's anybody can buy 10% or 1% or 50% or whatever they want to get, whatever the minimum is based on dollars or percentages. But the purpose of normally a stock split is to give you essentially a fractional share without it being a fractional share, to make it more appealing to lower value, lower net worth, lower, purchase price. So if Amazon is $3,000, which is basically where it ran up to, and they do a 20-to-1 stock split, they basically, if you own one Amazon now, when the split occurs, now you have 20 shares of Amazon. But the price of Amazon is just the price now divided by 20. You don't make anything, you don't lose anything. So you have basically 1 share of Amazon, the split happens, now you have 20 shares. The stock was $3,000 for 1 share, now it's $150 for 1 share. So when you multiply your $150 price by your 20 shares, it still comes out to $3,000. There's literally no difference at all. Now you just own 20 fractional shares of Amazon, each worth 1/20th of the regular share. But now that's just the new price. So that's how it works. Now, historically speaking, it is bullish because typically it's more appealing to a retail investor who couldn't buy it at $3,000 or didn't want to buy it at $3,000, but now they can buy it at $150. So it is technically, for no other reason than just psychology, bullish. Now, for institutions, it's actually worse because if you're going to pay, per trade or whatever, well, if you were going to trade 10 shares of Amazon before and they do a 20-to-1 stock split, now you have to, pay to trade 20 times as many. So now you're trading 200 shares, and before you were trading 10 shares. So it's actually worse for institutions or like people that pay fees. Now, obviously retail and the new trading setup and everything, most people are not paying trading fees or whatever. So, there's pluses and minuses. Some of them are old school, some of them are psychology, but in the end, there's no actual difference with this. So for it to run up an extra 5%, 6%, 7%, or based on $10 billion buyback instead of $5 billion buyback, it's none of that really matters. It's all just, oh, it's news and it's bullish and it's whatever. But in all reality, what is that? Well, it's just a retest of the breakdown level, an attempt to reclaim this after putting in a new low, and potential to develop some bullish divergence. I don't think it holds. I don't think it's sticky. Again, it's possible we reclaim this level and we continue to consolidate here, but I'm in no way bullish on Amazon right now. Do I think long-term this is bullish for Amazon? I mean, I've told you guys a million times, I'm very, very bullish on Amazon long-term, and I think this stock split is genius, but we already heard about it like a month ago. They already told us they were planning on doing it, and they're going to do it, and we expect them to do it. So, in my opinion, is it already priced in even though we're going down? Yeah, it just looks bullish now. The doubling of the buybacks looks bullish now. But the truth is, going into the future, Amazon's not going to perform as well short term because, fuel prices are way more expensive. The labor to pay the people to deliver the stuff is way more expensive. The consumer is going to be doing worse. So you would expect their sales, their profits, everything to be worse into the future. So I don't all of a sudden think Amazon is a great buy here. Now, I have said multiple times, though, long term, Amazon is one of my most bullish investments or potential stocks. but I just don't think now's the time. I mean, but if you entered this short when we showed it up here the first time, I mean, you're already up 15% or whatever on it. So by all means, turn around. You can buy yourself a 15% profit, turn around and buy yourself a fractional share of Amazon. Or in this case, your 1/20th or whatever. But let's keep going. So Google is next. Google, this is just the same move. We broke down from a key level, come back up. We're retesting it. We're at resistance right now. We're slightly below 200 exponential and simple. We're trying to put in some kind of bullish divergence and push back up, but I fully expect this to go lower. So you guys know my target on Google is 22,341. I don't expect things like Google, Amazon, Apple, and Microsoft to sell off nearly as much as the majority of these other stocks in the tech industry, but these are all established, profitable companies, some of which pay nice dividends and obviously are like top market performers, or most dominant in their space. So if you got to be somewhere, I'd rather be in these things through a downturn than in some of these trash garbage stocks that don't make money that are still trading at like ridiculous PE. But Google probably heads down further. Obviously, I love Google, and YouTube. No sarcasm there at all. They definitely don't shadow ban or restrict things or people based on the words they use or the stuff they say at all, for sure, whatsoever. Microsoft, again, still looks good. Basically looks like the Apple chart, still slightly above the 200 or below. No, I'm sorry. Apple is still slightly above the 200 exponential and simple. Microsoft is below it. So Apple looks slightly more bullish. We are holding on to this though. This still looks like it could play out as a head and shoulders. Longer we chop around up here, the better it looks. But we do have kind of a drawn out left shoulder. So it almost doesn't look particularly great if we just keep chopping around. Because it's like, oh, now it actually just looks more symmetrical. So Microsoft, you would have been better off breaking already or just like pushing back to the upside to make me more bullish. But if you keep doing this, you're going to look even more like a head and shoulders. But target on Microsoft still 241. So, but that's all I have for today, guys. Hopefully you enjoyed the stream. Jump over in the chat, see if we missed any messages. But if not, I think that's where we're going to call it. All right. So Adam WJS, what's up, brother? Says, hey, crypto trend trader, do you have a link to your MA indicators with the slopes? Man, that's only private. It's just for the group members, unfortunately. And the group is currently full and closed for the time being. So just had a bunch of new group members enter. So we're at capacity for now. I will open it back up into the future. I have a bunch of other indicators down in the description that you can get for free. But the Jewel Thief most recent version that I'm displaying on here and the moving average slope indicator are the TJD TD Master are only available for group members. It's just a perk I give them for showing their support. And if you want to be in the group in the future, you can send me an email. And when I open it back up again, you will be on the list for one of the first people to get in. But in the meantime, man, unfortunately not. So yeah, I think that's it for today. Hopefully you guys enjoyed the stream. Loaded with knowledge, lots of key plays. Most important thing, obviously, protect your principal. Derive a strategy. Make sure that you stick to it. I say it over and over again, but remember, position sizing, risk reward ratio, probability of success. Master those things and you will be profitable in these markets. If you can manage your positions and not be saying, I'm all in, YOLO, you're going to do way better in these markets. If you can increase your probability of success by trading with the trend or whatever other thing you can figure out, you're going to be much more profitable in these markets. And then finally, if you can take risk reward trade setups that are high reward with low risk, something like 2-to-1 or better, or 3-to-1 or 5-to-1 or 6-to-1, even if the probability is 50%, if every time you flip the coin, you get $5 if you're right and you lose $1 if you're wrong, you're going to do extremely well in these markets. But you have to learn how to do all these things and be consistent. If you do that, you create a trade journal, you monitor, you figure out what works for you, you figure out what doesn't, you eliminate the things that don't, and you double down on the things that do. Eventually, you will have a trading strategy, risk management, and probability of success far superior to what most people, even experienced traders, will experience with investing, with trading, scalping short term, long term, whatever. So that is it for today. Obviously, none of this is financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research, trade responsibly. The most important thing, most important thing is protecting your principal. If you lose it, you can't make money with it. So make sure you don't lose it. And then after that, there's only one more direction you can go, and that is to the upside. So that is it for today. Appreciate you, Ralph, on the compliments. Good show, Brew, he says. It is Wednesday, 10:21 p.m. Eastern Standard Time. I am Crypto Trend Trader with our midweek market update on this March 9th, 2022. Catch me live for the next one on Friday at 11 a.m. Eastern Standard Time. And every single Wednesday and Sunday from 8 p.m. till 10 p.m. Eastern Standard Time. But that is it for tonight. Crypto Trend Trader with our midweek market update. And I'm out of here. And the Shin Chan too. Thanks, brother. Appreciate you, my man. Everybody have a great night. Like it, subscribe it, smash it all up. Love you guys. Take care of yourselves. Take care of your family. Peace them out.